About 30% of non-financial companies in their universe have had some benefit from government stimulus programs or the build-out of AI, et cetera. When you take a look, you're talking about Europe. In the US, how much is that a tailwind that has been understated in terms of corporate quality and giving you confidence to go into a number of companies?
Yes, I think you're absolutely right. It's been completely understated to me. And if I could just take a step back, you know, when we look at the macro statistics, the top-down numbers that were coming out, for a good part of last year and into the beginning of this year, they were giving the impression of things being weak. And yet, underneath the surface, there was a strength. And I think what happened is people underestimated the impact of this fiscal stimulus. Remember, it was announced some time ago, but it's taken a period of time for that money to actually make its way through the system. So the loans and the grants are now finally starting to be dispersed. But remember that even beyond the disbursement of these monies, you're going to have tax credits that can persist for many years. And it's interesting, right? It's in a number of sectors. I mean, the obvious ones, people think about the CHIPS and Science Act, but utilities are beneficiaries, right? When you look at the Inflation Reduction Act, energy companies are beneficiaries. So I really think it's going to have a lasting impact as a tailwind for these companies for the next couple of years.
How does November change that, though? Is there a chance that Trump could, if he was elected, unwind some of these?
Yes, and you know, we've talked a lot about that. And I think really the difference that might prevent some of these programs from getting unwound, I mean, granted, EVs are probably going to be something that's going to go. But when you look at, for example, energy companies, if you're a large oil company, you can get a tax credit for carbon capture. I'd be surprised if the Trump administration would take away something from an energy company. Or if we look at where some of the factories have been getting built, like the battery belt, those are in red states. Do you really want to take away jobs in red states? Probably not. So we think, yes, there'll be some adjustments, but I don't think it's going to be a widespread repeal of what we've seen already put in place.
So they need to pick and choose their battles depending on where the state is and potentially what the company is. Yeah. How broadly are you thinking about the impact of the election, though?
Yeah, you know, it's tough without really knowing what the policies are. I mean, you know, we hear and we think that some of the programs, if the Trump administration comes back into office, could be more inflationary. We've talked about tariffs and the like. It's hard for me to really gauge that. So really what I'm trying to focus on is what's going on with companies from a bottom-up basis. And when I look at what's going on with companies today, we're actually focusing EBITDA growth, so our measure of earnings, between now and the first quarter to be up about 6%. And that's pretty good. That's about in line with the 20-year average. I don't think a change in administration is going to have any impact on that. That's already in place. And we'll get confirmation of that as we go through earnings.
It's even harder when you're not sure who the candidates are going to be either, once you get to November. But we'll leave that there. Lisa, it's good to see you.
Nice
as
to
always.
see you too.
Thank you for being with us. Lisa Coleman there of JP Morgan Asset Management. Let's give an update on stories elsewhere this morning. We can do that with your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. TSMC overnight reported sales that grew at the fastest pace since 2022. TSMC is the sole supplier of NVIDIA and Apple's most advanced chips. And those AI chip orders helped to make up for lackluster smartphone sales, leading to revenue that grew 40% in June, the estimate just over 35. Houston is grappling with blackouts, blocked roads, internet disruptions, and spotty access to gas in the aftermath of Hurricane Beryl. More than 1 million homes and businesses are likely to be without power until at least tonight, according to the region's main utility provider. Beryl, now downgraded to a post-tropical cyclone, is carving a path to the northeast with 30-mile-per-hour winds. The National Weather Service warned of flash flooding risks for northern New York and New England today. And Spain is headed to the Euros finals after a 2-1 victory over France. The first of Spain's goals was shot by Lamine Yamal, who is only 16 years old, the youngest to ever score in a men's European championship. Spain will now play the winner of today's Netherlands-England match, where I will be glued to my TV at 3 p.m. Eastern. And that's your brief, John.
With Bloomberg TV up at the same time, of course, Dan.
Of course.
Thank you. Yamal, what a player. Honestly, 16 years old, turned 17 on Saturday before the final.
The maturity to be able to deal with that kind of pressure, with that kind of gamemanship, is just really just beyond imagination for a 16-year-old.
Absolutely phenomenal. Can't wait for the final later this weekend. Up next on the program, a Democratic Party divided.
I believe Democrats will win up and down the ballot. Joe Biden will be reelected, and we're going to take the House.
He just has to step down because he can't win.
That conversation up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equity hit positive by 0.25% on the S&P 500. The lift continues in this equity market. Yields are down by 2 basis points. The 10-year 4.27. Under surveillance this morning, a Democratic Party divided.
We must get behind him. We must support him. Donald Trump's election would be extremely destructive to American democracy.
House Democrats are very confident in the agenda that we have been a part of for the past few years.
I believe Democrats will win up and down the ballot. Joe Biden will be reelected, and we're going to take the House.
He just has to step down because he can't win.
Here's the latest. Congresswoman Mike Sherrill of New Jersey becoming the 9th House Democrat to call on President Biden to drop out of the race. Biden's campaign working to restore confidence in his candidacy and bolster support from progressive leaders around the country. Joining us now, I'm pleased to say, is the Democratic Congressman Jonathan Jackson of Illinois. Congressman, thank you for being with Bloomberg Surveillance this morning. I just want to share a quote of yours with our audience, which I think is going to imply where you stand. I think he's up to the grueling call of the presidential campaign season. A question I would have for you, Congressman, I think is a question that a lot of people in this country have too. It's not just about the 4 months ahead of us. It's the 4 years after that. What gives you the impression that he can handle not just the campaign for the next 4 months, but the 4.5 years of governing he'd still need to do?
Well, I think he's got a great team around him. I think his agenda is clear. His focus has been very precise. When I think of what the alternatives that we are confronting at the moment, it's about direction, it's about character. President Biden has been very robust on the campaign trail in the last week since that debate, if you will. And so I'm very excited for him. I think that he's got a very strong number 2 in Vice President Kamala Harris. And he was able to share with us as the CBC members on a private Zoom call. He was able to take our questions. And so I'm very excited. I'm very confident that he can go forward, and we'll go forward in a very robust manner.
If you think he has a strong number 2, and he's 81 years old, and the polls continuously show, not just post-debate, this has been an issue with the electorate for over a year, that they just think he is too old to continue, why not promote the number 2?
I think he has been promoting Vice President Harris, and so we don't know what the future holds, But I would tell you this, that they've been out on the campaign. This has been a scandal-free administration. He's been very focused. If you look at what the alternative is on the chaos, the confusion, the calamity, if you will, I think the press has not put it in the proper light. If you think at a person that's been convicted by a jury of their peers of sexual assault, you usually get a handle on your name being called a sexual offender, former president. But no, they've given him a pass on that. So character is on the battle. And I think the African-American community is very clear at what's at stake. We've gone in the wrong direction with the United States Supreme Court. If you will, we've had 116 justices in American history, roughly 12,510 representatives in the House of Representatives. We've had 46 presidents. But this non-elected group of people that sits on the United States Supreme Court is able to dictate law. I think we need to look at some sort of judicial reform in the future, that the power that they have and the corruption that they've displayed is unprecedented. So the Supreme Court is on the ballot for this election season as well. And I would trust President Joe Biden and Vice President Harris to make that decision and recommendation before the American people.
Congressman, I want to share you some new data we got this morning from the Cook Political Report. They said that Trump's currently is 47 to 44% lead, the most dramatic shift they've seen in this race. And David Wasserman, an analyst there, said, quote, Trump's current numbers among Black and Latino voters are incompatible with any plausible Democratic victory scenario. What does Joe Biden need to do to really shore up the Black and Latino communities?
Well, I think he has to continue to stay in front of the community and also share with them all the things that he's done and what's to be promised in the future. It's we know on the Sunday before the Tuesday election, most Democratic candidates find their way to the African-American church. There are some more gains that the African-American church certainly deserves in the African-American community. If you think about what President Biden has done, one thing that's huge, and there have been many things, is that this is the first time an African-American woman was even considered to go onto the nation's highest court in Ketanji Brown. And her opinions and her decisions, her character is very important for us to have there. What he's done on trying to put people on the judiciary has been very outstanding. We're now seeing the erosion of African-American wealth. We're looking at going towards 2050 where there'll be zero African-American wealth that's also being projected. If we can talk about peace and security in Ukraine and Israel and Gaza and Taiwan and talk about rebuilding plans, we can talk about rebuilding urban America. Those persons that have had the history of being the descendants of Americans that have been enslaved, that have faced redlining, that have faced all the worst of America, that have been truly American since the founding of this nation, have not had an economic plan that has been sustained and that has been implemented. Our cities don't have to look this drab and this dire. We can also pick up people in America. And once we do so, we will expand the market. I believe in America, I believe there's a lot more potential. When we saw the past of segregated athletic fields, once they were transformed into a level playing field, now we're proud of the NBA, proud of Major League Baseball, proud of all of these other endeavors. We can do that same with our economy. When people have equal access to capital, that has to be a major focus of the Biden administration. What are going to be the financial institutions created to have long-term sustainable growth and inclusivity in the American economy? That's a promise, that's a commitment that should be made to the African-American community. It'd be good for America, it'd be good for the world.
Congressman, I want to go back to what you were talking about at the outset, where you were saying that it's character on the ballot, is who you are going to elect as just a person, a candidate, and you're talking about Donald Trump. There are a number of polls that have shown that Kamala Harris or many other candidates would do better than Joe Biden across from the ballot, across from Donald Trump. Why are you still supporting Joe Biden if you think that he has a lesser chance than other potential Democratic contenders to win in an election that you're framing as quite important?
Well, I would say it this way. You're talking to someone that's in elected office, and anyone that's been in this position before, you understand critics come after doers. And so we don't look at all the opinion polls. Opinion polls will tell us we're wrong. Opinion polls will tell us that we shouldn't, we can't win, and we've overcome many of those obstacles. We're in the position now of molding and shaping opinion, and that's where I stand on the side of. I appreciate those that have dissented. I disagree with them. I think it's healthy that we have debates. I would have liked to have seen a more rigorous primary debate schedule that gives other persons the opportunity to get on the stage, but here we are. We're about 4 weeks away from the Democratic Convention, and I think these different opinions and party persons that may disagree, I disagree with them, but I respect their opinion. I think in the end, it all comes together. And so I don't want someone to be crowned the next president. If someone has a dissenting voice, I want them to be heard at the convention. Let's keep it open. Let's keep the conversation robust. And let's take our case to the American people. This ultimately is decided not by the donors, but by a radical proposition, and that is that every person has a vote and it counts on Election Day. One person, one vote. And so this is where the billionaire class and the working class all have one voice, one vote on Election Day. So I follow opinion. Now it's time for us to shift opinion, not simply follow what the opinion polls are saying.
Congressman, I wish we had more time because we've got plenty of follow-ups to that particular last comment. Congressman, thank you. Congressman Jonathan Jackson of Illinois joining us from Washington, D.C. I know you wanted to jump in right at the end.
Well, he's a staunch supporter of Biden, but he said he wished there was more of a rigorous primary. Was this an error?
An opening to debate a little bit later on this summer in August.
Yeah, and this is the key. They're trying to shift opinion that has not gone their way. The question is, what if they can't?
The third hour of Bloomberg Surveillance up next. Tracy McMillan of Wells Fargo, Craig Trudell of Bloomberg News, Stephen Englander of Standard Chartered, and Veronica Clark of Citi. From New York, this is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is a market that we still see as fairly constructive. We believe the equity market rally can continue to trudge higher.
These concentrated moves and these handful of names have really masked everything. With markets at the highs, again, markets don't have to stay at the highs.
We get caught up in the broad indices. You look below the surface, markets are only doing okay.
It just feels like there's very few bulls out there. Everybody that comes on has kind of a bearish tilt to them. And bear markets don't really start that way.
There is an unprecedentedly wide range of outcomes possible. So no longer can we think about investing around a central base case.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Looking ahead to day 2 of Chairman Powell on Capitol Hill, Neil Dutta of Renmac writes in, the chairman understands the trade-offs have shifted. That's important. Now they need to tee up the cut. I don't think anyone's expecting that a little bit later this morning.
He's not going to come out and say September is on. I did hear from Neil Dutta as well when I was saying that we're up by 0.07, saying, come on, Lisa, up is up. So we did see at 36 the record gain on the S&P 500, regardless of what we hear from Fed Chair Powell. But what we are hearing under the surface is that Fed cut is crucial to a lot of the bullish calls later this year.
What we heard from him yesterday, he said he wouldn't give us clues on the timing of a policy change, and then he kind of gave us clues on a timing of a policy change by acknowledging that elevated inflation was not the only risk. And I think this is really important. This is the shift from the chairman. This is about the shifting balance of risk that people like Neil Dutta and many other people on Wall Street are thinking about. For the last 2 years, almost exclusively, we have only talked about one side of the dual mandate because the other side was so strong you didn't have to look at it. Labor market was good. Let's focus on getting inflation down, hiking interest rates, staying there and remaining restrictive. Now you start to see some fraying of the edges, which is what Kathy Bosch-Jancis of Nationwide said to us a little bit earlier this morning. Claims starting to tick higher. Unemployment starting to inch up. There's a reason to have that more balanced view, to acknowledge the two-way risk, that risk cuts both ways, not just look at price stability, but look at full employment too.
As he was saying, this is not an overheated economy, and the specific language, elevated inflation is not the only risk we have. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. Does this put on the table, if there is an undue weakening, of course I want to hear what undue weakening means, do they cut by more than 25 basis points? You know, what is on the table? What are they looking at for their metrics? They won't tell us, but we'll ask.
He also talked about, to your point, Jonathan, the labor market cooling. And as he said that, he said considerably from where we were 2 years ago, and I wouldn't have said that until the last couple of readings. And that's why I think everyone says, okay, now he's teeing up the cut. He's ready to go. He's talking about the fact that the data has been moving to his side to do this. I was struck, though, not just by what Neil Dutta said to you in a private message that you shared with us earlier, know something Sherlock, but what UBS put out today from Paul from The Economist. Perhaps Federal Reserve Chair has opened an economics book. Powell told the Senate Banking Committee that cutting rates too early would be bad, but cutting rates too late would also be bad. Unfortunately, the Fed chair insisted that more, quote, good data was required to induce a rate cut. The market is just ready for it, and that was from Paul Donovan.
Paul Donovan, cutting, bruising, brutal. Look, they've been stung before by a couple of head fakes. We've had the chairman come out in the past and talk about the disinflationary process has started, which has given the impression they can back away from this restrictive policy. And then Q1 happened. After Q1 happened, when you started to get these upside surprises on inflation again, they just needed some economic data to give them more confidence, give them specifically the confidence that Q1 was a head fake. So when they talk about needing more confidence, I think that's directly what they're talking about. The Q1 was a head fake. We can move on. We won't be in the history books for making the wrong decision out of the 1970s move, and we can look at protecting and insulating this labor market. I think the question that a lot of people have, including Neil and others, is that if you wait and you keep waiting, there's a risk here that you might be too late. And if you think about the decision in front of them, and certainly this is not a criticism, I think this is really difficult. What is the biggest risk right now? Holding too long, cutting too soon. And you can just hear it in the commentary on the Wall Street side of things that they believe it's holding too long and not cutting too soon. And that's a change in the last 12 months.
Especially because you have two prongs of the dual mandate of the Federal Reserve. It is unemployment or the labor market, and it is inflation. And if you look at both of those metrics, they both are moving in a direction that would send a green light to them to cut rates. So a lot of people are saying, why wait? This is, to me, the issue, because if you're conditioned by recent events, you think, wait a second, we might not know what we know. And that's why I want to understand even how they are looking at the current economy that a lot of people are saying is very different than one that we've ever seen before.
CPI data coming on Thursday morning. Equities right now on the S&P 500 going into the opening bell, just about positive by 0.25%. Yields a little bit lower, down 2 or 3 basis points. 426.66 on a US 10-year. Coming up, we'll catch up with Tracy McMillan of Wells Fargo as stocks hit their 36th record high of the year. Bloomberg's Craig Trudell with Tesla on track for its 11th straight day of gains. And Veronica Clark of Citi looking for the Fed to start cutting in September. We begin with our top story, the S&P 500 hitting its 36th record high of the year so far. Tracy McMillan of Wells Fargo saying investors should rebalance to avoid portfolio equity concentration risk. She recommends trimming tech and communication services and adding industrials, materials, energy, and healthcare. Tracy's with us now for more. Tracy, let's talk about that. Your picks on what to trim and what to add to. What's behind both?
Yes, thank you, John. So market breadth, as everyone has been talking about lately, has been extremely narrow, with the top 5 names so far this year contributing about 60% of the returns. And a lot of that is coming from communication services and information technology. In fact, those are the only 2 sectors that are outperforming the broader S&P 500 index. So we think that it makes sense to take some gains out of those 2 sectors and then look at those sectors that should benefit from a broadening out of the earnings recovery later this year. And we see sectors like healthcare, energy, industrials, and materials benefiting later in the year from that broadening.
Tracy, putting that together with your Fed call, you only see 2 cuts in 24, I think 1 as well in 2025. If you're looking for that, plus a broadening of the earnings backdrop too, it sounds like you're pretty constructive on this economy. Is that fair?
Yes, so we are expecting growth to continue to slow. We do think that we're going through a soft patch here, but we think it will be a moderate soft patch. And as the Fed starts to cut rates, we do think that that will help to stem some of the consumer weakness that we're starting to see. And we also think it will make credit more available. And those 2 things we think will lead to a modest recovery as we move into 2025. And so our targets are higher for U.S. large caps in 2025 than they are today. We do see some probably choppiness here through the end of the year, but looking out a little further, we do see that prices could easily be higher by the end of 2025.
Tracy, this is fascinating to me because of also how similar it is to Dan Scully of Morgan Stanley, who was on earlier, talking about how he too is expecting a broadening out. He too is seeing even areas that face consumers, that depend on consumers, that are more highly leveraged, that are in the sort of weaker cohorts, as doing better as the Fed cuts rates. Is this all contingent, Tracy, on the idea that the Fed will cut rates in September or sooner to sort of get the cycle started, and then you can start to see the true broadening, and you're trying to get ahead of that?
Yes, our base case is that scenario exactly, Lisa. However, if the Fed does not cut rates, it's probably because the economy is actually doing better than anticipated, in which case we would expect earnings to continue to improve and continue to support prices.
This is sort of the push-pull that people have right now. If that does happen, though, the actual participation of certain names will change because this has been a very bifurcated economy. Is it too soon to sort of go full force, in full throttle, into some of the broadening out trades, into some of the other names that haven't really kept pace with the Magnificent Seven? If the Fed hasn't cut rates yet and you're not certain, and where things are now, that kind of strength would just support what we've seen is already winning.
Yes. So, really what has been winning is the AI-fueled trade. And this is a long-term trend that's playing itself out in phases. And phase one is that direct investment in technology stocks that are going to benefit from the new technology. Then phase two is really the data center build out, the capacity build out, the energy needed to support that. So that should support materials, industrials, and energy. And then phase three is those companies that are going to benefit from improved productivity. And healthcare may be among the sectors that would benefit most there. So we do continue to support that broadening out into other sectors away from communication services and info technology, although we still have a neutral position there, so we're not underweighting those sectors, but we are saying take some gains and spread it out a little bit.
Tracy, you talk about momentum being the equity market. What's the biggest risk or vulnerability then to that?
Yeah, so the biggest risk is investor sentiment. So liquidity has been driving a lot of this market. Momentum has been driving it. And should investor sentiment start to falter, then we think that some of the momentum that's been driving the market would certainly come out. Now, what could cause investor sentiment to weaken? Certainly, if growth slows more than expected, if growth slows at the same time that inflation does not cool as much as expected, if the labor market continues to soften more than expected, there are, a number of factors that are dependent on upcoming data that will help to guide us in terms of, just how all of this is going to play out.
Tracy, wonderful to get your input. An update on your call. Tracy McMillan there of Wells Fargo. Looking for that broadening out of the earnings. We heard that a little bit earlier from Dan Scully at Morgan Stanley as well.
Well, how much does this really hinge on the Fed rate cut? This sort of idea that will pave the way for a new kind of, earnings boom, et cetera. It's just really interesting to me to see kind of all the things that have to fall into place for that to happen, and then what happens with some of the AI stocks. I mean, basically, it's all $7 trillion in money markets being unleashed into markets, and everything wins.
It's something like that. But there are two very different cuts. And the kind of rate cut that Tracy's looking for is the more bullish, constructive rate cut, which is the fine-tuning, sort of the mid-cycle adjustment. The growth is decelerating, but growth is still okay. There is another one, right? The undue weakening of the labor market, that one. If unemployment starts to climb higher, maybe too high and they're too late, that's a very different kind of rate cut.
The broadening out call is a resounding endorsement of the soft landing call and of the idea that rate cuts are part of that as a mid-cycle adjustment.
Let's get you an update on stories elsewhere. We can do that with Danny Berger. With your Bloomberg Brief, here's Danny. Hey, Danny.
Hey, John. Donald Trump is getting closer to announcing his vice presidential pick. During a campaign stop in Miami, Trump teased but did not officially announce that Florida Senator Marco Rubio could be his choice for running mate. He did stop short of making an official announcement, but did say that he was officially challenging President Biden to another debate, this time without moderators. Saudi Aramco has launched its first dollar bond sale in 3 years. The world's biggest oil exporter is selling bonds at 10, 30, and 40-year maturities. It's hoping to raise at least $3 billion to fund several large-scale projects. Saudi Arabia's government and affiliated companies have borrowed vast amounts this year, topping China as the biggest issuer of international debt among emerging markets. And the #1 at Wimbledon is out. Jannik Sinner, the world's top-ranked tennis player, was eliminated yesterday after losing a 4-hour, 5-set quarterfinal match to 5th-seeded Daniil Medvedev. It was the tournament's 36th match to go 5 sets, a new professional-era Grand Slam record. The quarterfinals continue today with Novak Djokovic continuing his quest for his 8th Wimbledon title. And that's your brief, John.
Danny, thank you. And I think a walkover in that semi-final. Novak will be in the final this weekend. A fiery Novak Djokovic. Did you see that earlier this week?
That was pretty interesting.
Going at the fans saying, you can't touch me. I've been in much more hostile environments.
Yeah, well, everybody needs to get their energy out.
He doesn't like the booze. Does not like the booze.
I get it. I think he's sensitive to the booze with the family in the crowd, with the kids in the crowd. I did notice that. But were they booing him? That's a very separate debate that ultimately he doesn't want to have. Okay. Up next on the program, the morning calls and Tesla looking for 11 straight days of gains. This is the 11th. We're up by about 0.5% in the pre-market. From New York, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities on the S&P 500 firmer here by 0.25%. Let's get you some morning calls. First up, TD Cowen raising its price target on Meta to 600 from 530. The analyst saying Meta's AI focus is driving revenue growth across the business. Next up, your second call from Needham, boosting its price target on Apple to 260 from 220. The analyst citing the decision to buy back $110 billion in shares when others are spending on Gen AI. It's an interesting one. And finally, Goldman raising its target on Tesla to 248, maintaining a neutral rating. The analyst citing better than expected 2Q deliveries, adding the reduction in inventory levels is a positive sign for future pricing. Tesla, you've seen the run, looking to make it 11 straight days of gains in today's session after posting 10 just yesterday. Bloomberg Trade Dow joins us now for more. Craig, this is quite a run. It's 10 days of gains. We're up by more than 40%. Bill Gross, the founder of PIMCO, coming out and saying it's trading like a meme stock. What are you hearing? What are you reporting on? What is happening with this name in this market?
It's hard to disagree with Mr. Gross. I think you look at what has happened to the fundamentals that he alluded to. Goldman may sort of look at the inventory clearing that we saw in the second quarter as positive. Maybe some stabilization in the margins for this company, but those margins have been moving dramatically lower over the last year and a half as the company has significantly cut prices. And we have not seen, a sort of result of that being increases in deliveries. We've seen the company really over the last 7 quarters see very, very flat deliveries. So this is a growth company that is no longer growing. And real questions about where that growth is going to come from going forward if the company is unwilling to add to the lineup, which Elon Musk has given every indication that he doesn't want to expand the lineup, that he wants to continue to really leverage the Model 3 and the Model Y for the vast majority of this company's sales.
Well, you know what the carrot is now. It's August, and it's the robo-taxi business. We're talking about price of the company for growth that doesn't have any. Craig, can that story turn that growth story around?
I think there's real reason to be skeptical there, just on the basis of, we look back at the years of experience we've been through with, Musk talking about this and putting this on the drawing board. You go back to 2016 when he was really first talking about this idea of trying to make this a business, of putting self-driving vehicles on the road, a shared fleet of them. Tesla, running that fleet, managing it as a sort of Uber competitor. And this was all something that, was on the drawing board way back in 2016. And, really executing that has proven extremely difficult. And you look at the sort of segment leader in Waymo, they are making really remarkable progress of late in making their service available, more to the public. But scaling that business has been a real slog, and they've really focused on particular markets, whereas Tesla has set a much higher bar for itself with wanting to do sort of general purpose autonomy. So how exactly they square that circle is really going to be something to watch on August 8th when Musk has scheduled this unveiling for.
I think you're very diplomatically sort of doing the collective head scratch that we all are in terms of why now, in terms of this rally that we're seeing in Tesla stock. This actually adding to that collective head scratching. given the fact that there is a report citing Cox Automotive research showing that Tesla's share of electric vehicles in the U.S. has fallen below 50% in the second quarter. They've lost ground to General Motors, Ford, Hyundai, and Kia, all of them actually gaining on them in terms of their EV sales, even as collectively there seems to be some steam lost. How much of a hurdle do they have at a time where a lot of companies might have de-emphasized the EV, but are still gaining share and creating a buyer base?
Yeah, I mean, I think, for Tesla to go, below 50% is a pretty significant milestone. It's sort of been assumed that this company was not only, dominating the EV market, but going to continue to dominate it, sort of in perpetuity. And I do think that you do hear from some people that this is maybe kind of part of the plan, this idea that the EV market is going to get more and more competitive, that Musk doesn't necessarily want to play that game, that he wants to sort of, take this great big leap. And I think that may be all well and good and be the sort of thing that you would expect of a disruptive company. But I think people underappreciate just how difficult it's going to be to get a car to where, you don't need any human behind the wheel. And I think we need to look no further than all of the money that Google has pumped into this effort for years. And really done this in sort of, step-by-step fashion. Musk, as we know, is not one to really sort of be patient, work well with regulators. And this is an industry where, one accident, one collision with a pedestrian or with a vehicle that results in fatalities can lead to you no longer being able to operate on the roads that you've been on. And so we've seen that from Uber, we've seen that from Cruise. And, I don't think necessarily that there's a reason to think that Musk is going to suddenly sort of change his ways and work better with the authorities who will give him the green light, at least initially, on the basis of the promise that this technology offers.
Craig, do we talk too much about Tesla simply because Elon Musk is such a firebrand? I mean, he's liking a lot of the oxygen out of the room. Tesla shares are up 5.6%. I just looked at General Motors shares. They're up almost 30% year to date. I mean, how much has sort of the drama around Elon Musk and Tesla overshadowed some of the gains that some of the other auto manufacturers have made?
It is a really interesting question, and I do think that some of the gains that you're seeing among some of these other automotive names has actually been on the basis of, these companies have been spending sort of like drunken sailors to try and catch up to Tesla, and maybe it's not the best use of capital. Maybe we would be better off actually, getting some of that back in the form of a dividend and a buyback. And I think, those shareholder returns actually is a big sort of factor behind GM. But I think the reason we do talk so much about this company, you want to talk about the 10-day run that this stock has been on. I mean, it's added $250 billion worth of market cap over that stretch. And that's, multiples of what some of these other companies are worth. And so, do they get talked about an awful lot, really, until everyone's blue in the face? Absolutely. But it is, for good reason in the sense that we just don't see these sorts of moves in terms of, market cap gains among anyone else in this space.
Craig, I want to ask you about the tariff hurdle because rival BYD signed this deal to start now producing EVs in Turkey. Is this a way they can sidestep the tariffs that Europe has put on? And is this something potentially Musk should start doing?
I mean, they're not only setting up in Turkey, as you've alluded to, but also in Hungary. So they've already started work on a plant in Hungary. I do think it's really interesting in the sense that, the Chinese car makers have had these big ambitions to crack the European market. They've done so in a way to try and avoid the scrutiny that they ultimately weren't able to avoid in the sense that even making bits of progress in cracking this market was enough to really set off alarm bells in Brussels, and we have seen these tariffs put into place. This would be a way around those by setting up local production, and I do think that this is an underappreciated. Those are at risk of real pain in the form of these tariffs that are coming into play in the coming months.
Hey, Craig, appreciate the update. Thank you, sir. Craig Trudell out of London from Bloomberg News on Tesla. Quite a run. The best performing stock on the S&P 500. over the last month. Just a quick note on BYD. JP Morgan hiking the price target on that name by more than 80%. The latest call from them overnight. From New York City, more on day 2 for Chairman Powell on Capitol Hill. Up next.
Of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We are on the longest winning streak of the year so far on the S&P 500, equaling that run back in January of 6 consecutive days of gains. Equity futures this morning signaling we might add to it, up another 0.25% on the S&P 500, adding some weight to the rally on the Nasdaq 100, up another 0.4%. And the Russell, Lisa, trying to participate, up by 0.5% this morning.
Yeah, we've been talking about rate cuts and whether they'll be good rate cuts or bad rate cuts. One thing that I find fascinating, especially ahead of JP Morgan earnings on Friday, financials have been outperforming. They outperformed yesterday, and there is the potential for them to outperform again today. We know that small caps include that kind of bucket. That I'm actually watching most closely today.
Stand out for me so far this morning, the pushback around the politics. Dan Skelly, Morgan Stanley, Brian Levitt, Invesco, basically saying it doesn't matter. Whatever happens in November, markets are going to be okay.
people are looking at the actual profitability of the companies, and we heard that from Lisa Coleman as well, and it's hard to see how one candidate or another is going to really change that, especially given that a lot of the money that's being given to those companies is already locked in. Question is, longer term, and this is the bigger question, is for the bond market, will they wake up to some of the potential changes that could come down the pike or not? And it seems like everyone's saying that's kind of the bigger question than inequity.
Lisa Coleman was talking about going to some bank debt. We talk about tech names all the time. Yes, tech names have driven this rally. The financials, you brought them up. We're up 23% on Bank of America year to date. Goldman's up by similar amount, 22.6. Citi's up by close to 30. JP Morgan's up by 22. Look down the list. These names have had a decent run.
Given the fact that they, A, have seen a resurgence in deal activity, B, have been underwriting quite a bit of debt. We talk about supply. It's not just on the government side, it's also on the corporate side. And then you talk about just the fact that they've been able to buy back their shares and pay out dividends in a growing amount. I mean, basically, they're becoming more of a value stock for people who previously looked at them at growth, disappointed that they weren't, and now are sort of viewing them as a different place in their portfolio.
Let's get to that bond supply. Switch up the board and get to the bond market, the Treasury market. Yields pushing just a little bit lower. We're down by a basis point or two. It's all about the 10-year this morning, 4.28. Yesterday was about the front end of the curve. We had some 3-year debt, no problem there. We move further out along the curve as the week grows older. It's a 10-year today at $39 billion worth coming from the Treasury. A little bit later this week, tomorrow, in fact, we'll get $22 billion of 30-year debt. So just moving along the curve slowly as the week progresses.
You know, even if these are all incredibly successful auctions, I'm curious to see whether there is less appetite for longer duration bonds, given some of the uncertainty around the deficit, about pro-growth types of programs at a time where the economy is already going pretty well, and we have a deficit that's already the steepest that we've ever seen it. So these are some of the questions that people have that we haven't, you know, okay, yeah, Brian Levitt was saying he hasn't seen the bond vigilantes. Show them to me. Fair, although on the edges we've seen people come out and just sort of express some concern.
Seen it elsewhere, seen it in the UK.
Yeah.
Start to see it in France just for a minute, maybe a couple of days, a week or so. Will we start to see it in treasuries later this year? We'll see. I think we got a scent of it, just a little scent of it, a sniff after that debate a couple of weeks ago. We'll see if that continues. If you want to see no price action at all, and you have access to a Bloomberg terminal, WCRS, just get a snapshot of G10 in foreign exchange. Euro's doing nothing. Basically, the whole of G10's doing nothing, with the exception of the New Zealand dollar and Norway's currency. The rest of it, barely moving. The euro, 108.25. We're positive by 1/10%. Let's get you some stories. Under surveillance this morning, industry research firm IDC saying Apple saw a 21% gain in personal computer shipments for the second quarter. It marks the largest gain for any PC maker. Tech companies are teasing new AI computers as devices age from the pandemic era. So is this going to be like this new phase of PC buying?
PCs sound cool again when you think about the fact that maybe you can get one and they have some interesting AI advantage. I was looking at Canalys research, and they really are gearing up for the next few quarters this AI adoption to start to ramp up, and it's going to help the likes of not just Apple, but Dell, Lenovo, all of these companies, because it's like vintage. It's cool again. What's old is new.
I don't know. I'm struggling with this just because I honestly wonder what kind of AI advancements we're talking about. Is it just that you've got a cool emoji? Is that going to be enough to get people going? Is it that you have, you know, a better search function? We talk about AI as though it's sort of creating this, you know, new factory. I think it's important to kind of look a little bit more at what it actually is achieving, because it could be different. Efficiency gains at a bank, I get. What it's going to do on your PC?
I totally agree. I'm not saying that maybe what's advertised is worth buying, but clearly it's working because they're being able to sell a lot more PCs, which notably it was buy a little bit of bigger phone, get an iPad. Now it's, I actually want a PC maybe because I can tap into this AI world.
If you're really bored of the weekend, turn on the golf over the next few weeks and you'll see some commercials for new golf clubs with the letters AI in them. I don't understand it, but ultimately everyone is using those two letters to try and sell product.
But that's my point. I mean, is it an AI golf club? Is it going to magically understand the
developed with AI?
Yeah. Is that it for your perfect swing?
Apparently.
Right?
All right.
8 handicap.
Yeah, 6.
6.
No, 8. He corrected it, right? It was 6.
But this was
then he clarified it was 8.
But a few years ago.
Okay. And Donald Trump doesn't believe him.
Right.
And most people that listen to that don't believe him. Okay. We're talking about the debate again, aren't we? All right. Treasury Secretary Janet Yellen on Capitol Hill facing questions from lawmakers over President Joe Biden's health.
As a cabinet secretary, have you noticed any mental or cognitive decline in any of these meetings?
The president is extremely effective in the meetings that I've been in with him. That includes many international meetings that are multi-hour, like his meetings with President Xi.
That was Secretary Yellen on Capitol Hill yesterday, somewhat evasive about when the last time she actually met the president and when they last had a direct conversation in person.
She was talking about these big international meetings. She sat with him across from other heads of state, but she wouldn't say when she was last in the room with him. She would not give that date. And then Representative Lawler went on to say, has there been any discussion amongst the cabinet about invoking the 25th Amendment? And she said flat out no. But this is a preview of more to come. Any cabinet official that, say, testifies in Congress or sits for an interview, the first few questions are going to be, what is the mental acuity of the president today?
Based on the last 2 weeks, they're questions that are warranted, aren't they, for cabinet officials?
You know, they are warranted. And this is the tricky aspect to me. And I think that you asked the right question earlier, which is career risk, which way? What we've heard is a Democratic congressman come on this show today and say, essentially, we're trying to change the message. We're for him. We're going to back him. Whether we should have done it differently, we're not going to talk about that right now. What I want to know is at what point it is sort of career risk not to change course now if it's going to be increasingly difficult to change that message simply with rhetoric.
Wouldn't it be good if it was just for the good of the country and not about the good of their personal career?
You're just trolling me.
I know. Fed Chair Jay Powell returning to Capitol Hill for day 2 of testimony. Powell in front of the Senate yesterday, keeping a September rate cut on the table while noting the risks of rising for the employment half of the Fed's dual mandate. Mike McKee is not bothering to focus on what's happening at the House because Mike McKee is somewhere else this morning. Mike, I understand you're at the Teton Economic Forecast Conference in Jackson. Why are you there and not down in Washington, D.C.?
Well, because it's a lot nicer out here, I think, than in Washington these days. Washington's a tough place to be. Jay Powell, though, has to be there. He can't do it via AI. But his testimony is going to be the same this morning. We've confirmed that with the Fed, so nothing new in his prepared remarks. But when they get to the Q&A, perhaps we'll get a little more of a focus both on when they might cut rates, because he sort of dodged that question a lot yesterday, even while keeping Wall Street's hopes alive, and on the politics of it. As Anne-Marie knows very well, the House is much more political in its questioning than the Senate is.
Michael, it seems like we got this sense that he is recognizing the weakening in the labor market that a lot of people have been talking about. He's talking about this is not a frothy economy. You're seeing a balance. And elevated inflation is not the only risk we face. If they don't cut rates soon enough or deeply enough, that could be a problem longer term for the labor market. I am paraphrasing that. Mike, I mean, how much are people saying that this is a shift in tone that's paving the way for a September rate cut unless something dramatic pops out to really change that view?
I think we're not quite there to say it's guaranteed, but it is a shift in tone that raises the possibility of September, puts it in play. The Fed is acknowledging through Powell, and we've heard from others as well, that the labor market has definitely slowed. We're seeing a rise in unemployment. We're already where they thought they'd be at the end of the year. You look at the Atlanta Fed GDP Now numbers, and they've come way, way down to about 1.5% for the quarter so far. Consumer spending is falling off. So they're seeing an economy that is slowing. Now, that is what they wanted. And if they are getting what they want and inflation stays well behaved, then you go back to the old question that Jim Bullard used to ask, is this the right interest rate for this economy? And by September, they may be able to answer no.
McKee, today, potentially, we're going to get more of those political questions. Yesterday, Senator J.D. Vance, a potential VP pick for the former president, asked him about immigration. And he said in the short run, it may actually have helped because the labor market got looser because there were more people. Is this the line that Powell is willing to walk? He is talking about the fact that, as Jonathan calls it, a leaky border, a looser border, actually aided what was going on in the labor market coming out of the pandemic.
Well, he was very careful to not go over the line and talk about, as he put it, the moral implications of this, whether people are legal or illegal. But we know how tight the labor market was. Companies could not find workers. So having more immigrants helped. It helped fill up many jobs out there. And going forward, the United States birth rate is falling, so immigration is important to keep potential growth up. That's all economics, so he feels comfortable saying that, but he doesn't want to get involved in the question over who should be here or who should not be here.
The politics, very different. The law as well. Michael McKee, thank you, sir, on the latest over in Jackson. Joining us now to continue this conversation, Veronica Clark of Citi, alongside Steve Englander of Standard Chartered. Veronica, I want to start with you. And a key feature of your call and the team over at Citi for quite a while now has been the deceleration in the labour market, and we're starting to see it. Do you feel vindicated? Do you think this incoming information is starting to validate this view that you've had for quite a while?
It was a very out of consensus view a couple months ago when we were talking about even the possibility that maybe the Fed would hike again. We were reaccelerating, and it is easier now to convince people that things are slowing. I think it's gotten much more evident in the labor market data the last few months. You know, we're still running consistently strong payroll job growth, but I think people are aware that there's maybe some issues with that survey. Maybe it is reflecting immigration, but we have had this increase in the unemployment rate that fundamentally is telling you there are more people who want jobs and don't have them. So yeah, I think we're still seeing those signs that we're headed to a slowdown.
There is still some daylight between you and the Federal Reserve. Let's be clear about that. You believe, Veronica, that ultimately that this gets worse. When they start cutting in September, they don't really stop. That's where the daylight is now between you and I think the rest of the street. I still sense the consensus on the street is mid-cycle adjustment, fine-tuning starts in September, go a couple of times, see what happens. Are they already too late?
Yeah. So I think the issue is that if everything stabilizes here, if we're at a 4.1% unemployment rate, yes, that is still historically low. That would look great. But that's usually not how these cycles play out. They start very gradually, very slowly, and we've seen that for a number of months. You know, not even just the last couple, but 9 months ago, we were starting to see these signs of weakening. And even at the start of the year, we did have this big loosening of financial conditions, and it hasn't been enough to prevent that weakening. So yeah, we're just expecting that this looks like most historical cycles, and unfortunately it gets worse. So.
Steve, what's your view on that? That essentially everyone's pricing in as their base case that the Fed has time, as they've said, to make mid-cycle adjustments to keep this soft landing on track. Do you agree that it's looking less likely the longer they wait?
No, I kind of agree with the Fed on this one, because if you look back to the most recent cycles that we've had, you know, in addition to whatever Fed tightening there were acts of God, whether there was COVID, the great financial crisis, even the collapse of the internet bubble in 2000. You know, it's been a long time since we've had a slowdown that's just caused by tightening. And, you know, so I think if the economy is slowing down, then all the data show a gradual slowing across a broad set of indicators, but there's nothing that suggests to me that we're going to go over a cliff. And I think the Fed realizes this, that, you know, you do 25 a meeting too early or 25 a meeting too late, the loss function, so to speak, is very flat. It's not like really steep. So if you miss it, you're done.
Veronica, what's your sort of rebut to that, considering the fact that a lot of people say it's not usually linear, these changes?
Yeah, I mean, usually it isn't linear, and we get that question a lot. Does there need to be a trigger? Does there need to be some external event that happens? And I don't think necessarily. I think this, could be, a traditional cycle, even if we haven't seen one in a while, where rates are restrictive and things slow down. I mean, we've seen, I think, for a while now that, firms are really looking to cut labor costs by not hiring, by cutting hours worked. What we haven't really seen yet are the layoffs, although we have seen this increase in initial jobless claims lately. But people are pulling back on spending now in the last couple months. They feel worse about employment prospects. If that means that you're cutting back on spending and that's less business revenue, maybe that's what gets businesses to that last step of layoffs. And those can really build on each other.
Steve, your reaction?
I'd say historically, it's very hard to find nonlinearities. I mean, especially when, the nonlinearity would be like a great financial crisis or some big event. And, you look at the labor market, you sort of see an S curve, that there are some firms that are going to be quick to lay off people, then you get to the middle part, and then you get to, where the process is done. So far, it looks like a very truncated S curve. And yes, we expect them to continue to lay off, but the question is, are they going to do it so fast that, the Fed says, oh my God, we should have cut in May, we're way behind. And I doubt that's going to be the situation that they face. I do think they've been overly hawkish maybe for a while, but it's not going to bite them in the back, so to speak.
Veronica, what do you make of that? Like, how does this look if there were to be layoffs, the speed of it?
Yeah, I mean, we're not talking, I don't think, of course, about a 2008 or COVID or anything. The unemployment rate, which has come up, from a low of 3.4 already to 4.1, maybe going 1.5% more, something like that, a little bit above 5. But I think that would be enough for the Fed to say that's an unexpected weakening of the labor market, at least to be cutting every meeting. We're expecting 25 a meeting every meeting. We're not expecting 50s or 75s. So it wouldn't be the most dramatic downturn, but it would be a recession, run-of-the-mill recession.
Steve, I wanted to push this through the FX market, which is tremendously difficult to do at the moment. You've put in your research, half the time we're thinking about Trump trades, broadly dollar positive. The other half we're talking about this deceleration in the economy, which might be dollar negative. How are you thinking about things? Do you focus on one half versus the other, or do you try and do both at the same time, Steve?
Well, you have to try and do both at the same time, while being cognizant that, every day's data matters. And I think overall the Fed cycle and the weakening of the economy is going to end up being the dominant force. Partly it depends, assuming that Trump wins, which is the assumption that most of the market is making right now. Assuming that he wins, the question is what he chooses to emphasize. He can go the cut taxes route and the, sort of high tariff route, which I think much of the market would think is, inflationary over the longer term. He can go on the drilling route, cheap oil, cheap gas route, which would be disinflationary. So I think the market is going, till we get to that point where we actually understand, assuming he wins, what he's going to do, the market will probably emphasize the activity side rather than the, rather than the political side, unless he makes this absolute commitment that the first thing he does is going to tariff up China or something.
Got it. Steve, thank you, sir. Steve Englander there of Standard Chartered in the FX market. Veronica, I just want to finish with you on that if we can. I'm sure clients are asking you and the team about it. What are you saying to them about November?
Yeah, we're going to get only more questions as the months go on. I think, we don't have a lot of concrete details of either, a Trump victory or a Biden victory. Obviously, it's going to depend on what happens in the House and Senate also. But yeah, both scenarios look pretty inflationary, look like wider deficits for sure.
If you had to say in percentage terms, is it like 50% on the Fed, the questions right now, and 50% on the election?
Still more heavily the Fed, I'd say.
Still the Fed.
Yeah. Okay. The political side is just a lot of drama still for now, maybe.
Veronica Clark-City. Veronica, it's good to see you, as always. Starting to feel vindicated about the incoming information. Certainly not what anyone would wish for, but ultimately that deceleration coming through in the labour market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Houston is grappling with blackouts, blocked roads, internet disruptions, and spotty access to gas in the aftermath of Hurricane Beryl. More than 1 million homes and businesses are likely to be without power until at least tonight, according to the region's main electric utility. Beryl, now downgraded to a post-tropical cyclone after striking Texas as a Category 1 hurricane, is carving a path to the northeast. The National Weather Service warned of flash flooding risks for northern New York and New England today. Microsoft and Apple have given up the chance to be observers on OpenAI's board. The move comes as global antitrust regulators step up scrutiny of big tech's influence on AI. Microsoft, which has invested $13 billion in the creative ChatGPT, sent a letter to the startup announcing its withdrawal from the board. And BMW is pulling away from its EV competition. While its German rivals struggled with sales in the second quarter, deliveries of BMW's battery-powered models surged 22%. That contrasts with a 25% drop for Mercedes and flat EV deliveries for Audi. BMW has rolled out several new battery models, moving earlier in the EV shift than many of its competitors. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate this morning. Thank you very much. Up next on the programme, setting you up for the day ahead. It's a busy one. We'll be back in just a moment. You're watching Bloomberg Surveillance.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Looking to make it the 7th day of gains on the S&P 500. We are firmer here, higher, adding some weight to the S&P. We're up by 0.25%. In the bond market, yields are a little bit lower. We're down 2 basis points. The 10-year, 427.83. As we count you down to the opening bell, about 38 minutes away, here's the trading diary through today and through the rest of this week. At 10 a.m. Eastern, Fed Chair Jay Powell wrapping up his 2-day congressional testimony. Plus, throughout the day, more Fed speak. We'll hear from Goolsbee, Bowman and Cook. On Thursday, tomorrow morning, is the big print, 8:30 Eastern Time, US CPI, another round of jobless claims. Don't miss the claims either. This is important. Are we starting to see a sustainable, more durable break in claims higher? That would, I think, be concerning for a lot of people on the FOMC. We'll also get Delta earnings, which is worth watching as well. And then we're looking ahead to this one right here, which arguably for some of you, across the nation, outside of Wall Street, is the event of the week. It's President Biden holding a solo news conference when the NATO summit ends. Look out for that on Thursday afternoon. Friday brings us PPI and unmatched consumer sentiment survey data. And then we kick off Q2 earnings. We get numbers from JP Morgan, Wells Fargo, and Citi. Lisa, on that screen, we've talked about this a million times. What stands out?
He's also going to be hosting a dinner for these allied nations and the alliance. It's at 8 p.m. And you can't joke about it anymore because the president told governors, according to reporting, that he was going to wind down activities and not be a part of them after 8 p.m. And what European diplomats are saying to us is, well, we wish we can focus more on the substantive issues at play at NATO, but we are also focusing on the health and mental acuity of the President of the United States.
Yeah, this is the part of the problem, isn't it? And two things, you talked about how high the bar was. The bar is so low for the president to clear. Just get through a news conference without any gaffes. For most people, that would be okay, but based on how this has been going, it's not. And on the substance, the fact that we're talking about a sitting president's bedtime and not 2 wars taking place at a NATO summit is just bizarre.
It's the reason why people have a hard time taking it seriously in terms of market action, simply because we're not talking about policy. We're talking about, I don't even know who's going to be on the ballot at a time where there's a coalescing of Democrats, but not necessarily confidence that comes with that.
And we heard that from the congressman today, the fact that he's going to stand behind Biden, but he did at the end there say, well, I kind of wish there was more of a robust primary leading up to this point, but now that he is top of the ticket, this is what some are feeling. We're just going to have to go with it. But they're seeing the polling. And what they're seeing is this potential, we heard from Senator Bennett yesterday on CNN, is landslide Trump victory. And now they're starting to think, well, career risk, maybe I get ahead of this.
Yeah, it's quite a 24 hours coming up for the world of politics and the world of financial markets as well. Coming up tomorrow to help navigate some of this, we'll catch up with Russ Kostrick of BlackRock. We'll speak to Sarah Hunt of Alpine Saxon Woods, David Kelly of JP Morgan Asset Management, and Steve Rasciuto of Mizuho. It's CPI Day tomorrow and a whole lot more for the President of the United States from New York City. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
This is Bloomberg.
Powell drove us to a 36th new record yesterday. Will it be 37 today? Less than 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now. Another day, another record for Wall Street. The S&P 500 on its longest winning streak since January.
And Jay Powell may power the rally even further. The Fed chair returns to Capitol Hill for day 2 of his testimony.
And risks remain to the rally as investors brace for key inflation data and the start of earnings season. So let's take a look at where markets are trading right now. 30 minutes to go until those bells ring. You can see we are building on yesterday's momentum. The S&P 500 currently up about 0.2% in the pre-market. market even better if you take a look at big tech, currently up about 0.4% on the NASDAQ 100. A little bit of a rally building in the bond market, that 10-year yield back below 430, currently down about 2 basis points, Matt.
So it's a big bet on tech revenue growth, also on bad economic news. You can see here this blue line represents economic surprises, and they're mostly to the downside of late. That has helped power the rally and valuations up to 22 times forward earnings as investors expect a cut.
And Matt, there are some stocks to watch before the market opens. Of course, I'm watching shares of Apple gaining after reporting a 21% gain in PC shipments last quarter. That was the biggest jump among all global PC makers. According to a report by IDC, Apple up about 0.4% pre-market. Also, Air Products and Chemicals watching it surge almost 2% this morning, higher after Honeywell announced that they're buying the company's LNG process technology and equipment business for $1.8 billion in all cash.
Joining us now is Lori Heinel, Chief Investment Officer at State Street Global Advisors. And Lori, you know, we continue to hit record after record, even with economic surprises disappointing, even with, you know, rate cuts. We thought at the beginning of the year we'd see 5 or 6. Now it's like 1 or 2. What do you think continues to drive us higher?
Well, there are several things that will drive us higher. First of all, is continued optimism about some of these long-term thematics like AI and digitization. And we're going to probably continue to see that as these companies have a lot of momentum in their sales activities and continue to kind of divine that future. But we're also seeing less concern about a recession, and that's going to help areas like banking. It actually should help some of the consumer discretionary areas, and so you're seeing a broadening out in the marketplace.
And let's follow that AI story, because we had Citi out with a report earlier this week saying it's basically time to take some profit in the high flyers of this cycle. Then you have BlackRock, who is still both feet into that AI theme. When do we see the AI rally start to broaden out? And is that the time to really follow it into something other than just the chip makers, for example?
Well, I think one of the keys is going to be, when is there something else that looks attractive that gets confidence, and that you actually have investors starting to chase those areas as well. So we do think that there are opportunities in materials and industrials. We do think that there are opportunities in some of these consumer discretionary areas, obviously select IT. So right now, people aren't concerned about the stretched valuations, but once you start to have other opportunities build, as we do navigate this soft landing, we think that there will be more vulnerability in some of those high-flying names.
Now, if you're worried about the high-flying names, Lori, how do you feel about some of the things that are starting to broaden out? I thought what you said was pretty interesting about the banks and consumer-focused stocks, given there is still a lot of concern around those names, and on many of those names are going to start reporting as early as tomorrow.
Well, first of all, we don't think there's any immediate concern. In fact, if anything, there actually are a lot of bright spots because we have continued to have strong economic activity. And we're starting to see that broaden globally. So if you look at our tactical allocation portfolios, for example, we've started to spread our equity bets a bit. So earlier this year, it was definitely more focused on U.S. large cap. But now we're looking at areas like Europe, where we think the valuations are relatively attractive. So we think trying to diversify your portfolio here so that you're not over-geared to those high-flying names, but you're also ready for opportunities as this market does start to broaden out.
What do you think about the leadership? I mean, are we going to see any changes, Lori, as we get deeper into earnings season? I know that Gina Martin-Adams from Bloomberg Intelligence is writing that you know, the Mag 7 earnings growth is going to slow down, and for the first time in like 7 quarters, the S&P 493, the other stocks in the index, are going to show expansion.
Well, we've been waiting for this moment for a while. And as you think about what's happening right now, inflationary pressures are starting to abate. So that may support certain industries. You probably see consumers slowing across the board, but very much pockets of strength still there. The banks will be an interesting one to watch because they may actually be able to release some of their reserves and things of that nature. There are still vulnerabilities in things like the commercial sector. So I think it's going to be a much more idiosyncratic market. You're going to have to look industry by industry and company by company as we broaden this market out.
And of course, we're waiting for the unofficial start of earnings season, which is, of course, the big banks kicking off at the end of this week. We have had some earnings come through. Helen of Troy, for example, results really disappointing there. A bit of a worrisome sign about the consumer.
Big downgrade this morning.
Exactly, that too as well. So you think about the state of the consumer, the softening consumer. You say that it's going to be an idiosyncratic earnings season, but how much of a common denominator is that weakening consumer in these reports that we're expecting?
Well, it's likely to be pretty bifurcated. We're already seeing that, right? If you look at the upper echelons, they still have the wealth effect. They're seeing their equity portfolios grow. They're seeing their housing values grow. They're not vulnerable in terms of employment at this stage in time. So they're actually in a pretty good spot. But as you note, if you look at the other end of the spectrum, there are vulnerabilities. The savings rates are going lower. You're starting to see some consumer delinquencies. Wage growth is not improving. So it really is going to be a tale of two cities. And that's why we're very much focused on discriminating and quality, looking at those quality balance sheets, those companies that have a bit of a moat and are geared to those places that are still growing.
How much conviction, Laura, do you have to put money to work at these levels? You're looking at potentially a 37th day of record highs in the S&P 500, and you have to wonder whether it's equities, cash, gold, fixed income. How do you think about allocation overall?
I'd say the first thing is we are still overweight equities, but we're also holding a fair amount of cash to be opportunistic if we do see a pullback. And as you know, we also are holding some gold because we think that that's one of the few diversifiers against some of the extreme events that we may see over the coming weeks and months. But I think it's important to note that within our equity portfolios, we are diversifying a lot more. We're not focused just on the Mag 7. We're not focused just on U.S. large cap growth anymore. It is a more broadening story.
Wait, when you say gold, you mean the actual soft metal or Bitcoin?
Well, the original crypto, I like to say, gold, the original crypto.
Not diversifying into, I mean, it's pretty amazing to see Bitcoin still holding. I think it's up again another 1% and change today to $59,000. Is that not an asset that you think is, important to hold in a portfolio yet?
Well, look, when we look at strategic allocation and tactical allocation, we tend to focus on those asset classes that have a little bit longer history, that have more stable correlations, where you actually can think about, analyzing them going back further. But look, there are opportunities. If you want to think about speculative opportunities, there are opportunities in all sorts of other assets, and crypto would be one of those. But size your position appropriately, recognize that it's going to have a lot of volatility.
All right, Laura, you're going to stay with us. We have more to talk about with you as Jay Powell goes in front of the House today. So Lori Heinel of State Street Global Advisors sticks with us after our 36th record high on stocks. Here you can see futures. So right now, S&P futures up 0.25%. If it holds, or if we trade in the green by the end of the session, it'll be a 37th record high. And we're only in the middle of July. It is, though, a very solid month historically for stocks. Coming up, day 2 of Jerome Powell's testimony. We'll preview what to expect from the Fed chair next. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together
whether it's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Let's get to high interest now. A look at what's making headlines around the world. Joe Biden's allies are trying to shift the narrative from the president's mental acuity to Donald Trump's policy goals. Many Democrats are warning of the dangers of Project 2025, which is a suite of policy proposals drafted not actually by Donald Trump, but by the Conservative Heritage Foundation for Trump to pursue if he's elected in November. The proposals range from gutting the federal civil service to blocking efforts to fight climate change. And Trump is getting closer to announcing his VP pick. During a rally in Miami, Trump teased the possibility of Florida Senator Marco Rubio, previously known as Little Marco, as his running mate. He stopped short of making an official announcement, but did say he was officially challenging President Biden to another debate, this time without moderators. NATO allies promised 5 long-range air defense systems for Ukraine in a fresh show of support. The treaty organization's leaders resisted offering the country a path toward membership, and fresh assessments indicate the conflict with Russia is headed towards, as you may have expected, an indefinite stalemate. Katie?
And also of high interest today is day 2 of Powell's testimony on Capitol Hill. Speaking today before the House Financial Services Committee, Bloomberg's Michael McKee joins us now for a preview. And Powell really didn't want to say anything about the timing of policy moves yesterday, but what did we learn from the Fed chair?
Well, there was a shift in tone or emphasis from Jay Powell yesterday towards the idea that the risks are balanced now between inflation and growth/unemployment. The Fed watching the growth figures come down, the Atlanta Fed GDP now number now down to about 1.5%, unemployment up to 4.1%, where they thought it would be at the end of the year. So the trends are towards a slowing economy. Now, July is too soon, but they could be setting up, if they get good news tomorrow with CPI at the end of the month, if they get good news from the PCE, and that continues, they could be setting up for September. But because they don't know what they're going to get in these data releases yet, Powell is unlikely to give us any kind of firm indication. The markets are just reading between the lines.
Michael McKee, we thank you so much for your analysis, keeping an eye on all of it, of course, in day 2 now of Powell's testimony to Congress. But for now, still with us, Lori Heinel, Chief Investment Officer at State Street Global Advisors. And you hear what Mike was telling us, this idea about more balanced risks between inflation and growth. But as an investor, what are you more concerned about, inflation or growth?
Well, look, we're concerned about both, and they're both intertwined. But we do think that the Fed needs to cut more rapidly than perhaps Powell is admitting at this stage in time. This idea of data dependence, while it's important, we see a lot of variability in the data, a lot of revisions in the data. And so I think what we saw in the testimony was recognition that those risks are more balanced and the labor market is cooling a bit. And we hope that that will give them the cover that they need to cut rates, ideally by September.
Well, Lori, to that point, you were out with a big call in April that you expected the Fed to cut rates in June. That didn't materialize. It seems like most people in the market are coalescing around September.
50 basis points, right?
50 basis points was the June call for Lori there. But why do you think the Fed needs to cut rates here? Because there's plenty of people that we talk to on this program and others that say the Fed has the luxury of being able to wait right now.
Well, look, we know that policy operates with a lag. And so if we look at the backdrop right now, we've got an economy that's going to grow at around 2% or so. We've got inflation that by the Fed's own measure is now below 3%. We don't think there's anything magical about the 2% number per se. In fact, not that long ago, the Fed was talking about a range around 2%. So this obsession with getting inflation durably below that target of 2%, we think is making the economy quite vulnerable. vulnerable. Rates at 5.25 to 5.5 just aren't consistent with an economy that's slowing at the levels that we see.
Well, let's talk about why it makes the economy vulnerable and why it might make the stock market vulnerable. Because you take a look at where we're sitting with rates at 5% or so, and it feels like you haven't seen sort of that higher rate environment play out in ways you might have expected in previous cycles. So what do you see as the risk of the Fed waiting too long to lower rates here?
Well, there are several things that have helped during this environment. Certainly one of the big ones is that their higher rates haven't bit into consumers as much as one might have thought. And that is for a variety of reasons. You know, the overhang of some of the stimulus that the consumers had, a little bit of wage growth and strong employment. And if you look at housing, for example, the bite just isn't there because you haven't had the turnover in housing that would reset the levels of rates in housing markets, for example. But it's also in businesses where they're not necessarily vulnerable. They have strong balance sheets. A lot of the refinancing risk is still sort of pushed out. But that doesn't mean that that doesn't create problems, because ultimately you do need to have good financing to grow. You do need to have attractive rates, et cetera.
It's pretty amazing. In fact, Torsten Slok was on this yesterday, and he pointed out that pre-pandemic, 38% of homeowners had a mortgage under 4%. Now it's 63% of homeowners that have a mortgage under 4%. So that reduces kind of the power of monetary policy, if you will. Do you think Jerome Powell needs to make bigger moves to fight that kind of drag? I mean, is that why 50 basis points he should be thinking about in your view rather than 25?
Well, our view is that he does need to act soon, and he should act with some intensity. So 50 basis points in September would be very attractive from our vantage point, and we think probably another rate cut before the end of the year. Because again, policy operates with a lag. If you're only doing 25 basis points each time, how long is it going to take you to get the rate from 5.25 down to 3.25, or perhaps even lower? Every day, if you will, that goes by, or every Fed meeting that goes by where no action is taken, that creates more vulnerability that we don't achieve the soft landing, that we actually have something more nefarious.
So, and he, you know, yesterday he was saying, yes, inflation is coming down, and they're confident about that. He also mentioned that the labor market is softening. And if you look at economic surprises, I know I harp on this, but if you type ECSU go on the Bloomberg, you can see that we just continue to disappoint in terms of the economy. Do they risk a recession if they don't cut, you know, a little bit further, a little bit faster?
We think that they do. And again, there's a lot of enthusiasm about some of the long-term opportunities, right? And we talked a little bit about digitization and other AI and other areas. But in the moment, if you will, consumers are starting to be vulnerable, particularly at the low end. The higher rates are starting to bite, and the longer that we maintain an imbalance between growth and inflation and those restrictive policy rates, the more likely we do have a recession.
Lori, let's talk about the potential for that September rate cut as the market is expecting. And you think about all that cash that is on the sidelines. You think about all the money in money market funds and the rotation you may or may not see. How do you think that cut will cause any repositioning? And do you think that repositioning may perhaps be already priced in?
So we think there's a slow repositioning already happening, and we are seeing more demand for longer durated fixed income, particularly some of the sectors like investment grade credit, where there's an incremental yield beyond just treasury rates. And we don't think this is going to be a tsunami, because even if the Fed does cut by 50 basis points, you're still going to see money rates that are 4 handle, maybe even a low 5 handle. So it's not going to be a quick change. But we do think that there is valuation in rates right now. We do see that there's volatility there, so it may take a little while to realize that duration bet, but that would be one of our favorite trades for the back half of the year.
And if you don't get that September cut, you kind of made this warning call here that every day that goes by without a cut and that rates stay high, it creates a greater risk of a greater downturn. How much room does the Fed really have, in your view, before causing something greater in terms of a downturn?
Well, they have some wiggle room here, but the big thing would be that they'd have to respond more rapidly and more intensely if they keep delaying. So there also is this trade-off where if they don't move in September, and then you start to get into, closer to the election period, and again, the Fed's not a political animal, but by the same token, they're going to be watching what they do very carefully, then all of a sudden you might have a very sharp fall off in economic activity or a sharp increase in unemployment rates. And then they've got to act a lot more responsibly. And will they be willing to do that?
Lori, it is so great to speak to you. Really appreciate you joining us on our launch week. That, of course, is Lori Heinel of State Street Global Advisors. It's so interesting to speak to Lori. Of course, we spoke to Torsten Slok yesterday. His big call was that the Fed doesn't cut rates at all in 2024. She obviously on the other side of that, saying that the Fed should have cut in June and they should cut right now.
Well, part of that view, too, from Torsten was this idea that they have that wiggle room, that things are still really strong out there. Yardeni seems to take this similar type of view, that things have not really broken to the degree you thought they would with a hiking cycle that has not only been so fast, but lasted so long.
On the other hand, depending on who wins in November, right, we've heard Larry Summers say that Trump's policies are the most inflationary he's ever seen. And, if Donald Trump is elected and puts those policies in place, I know, those are some big ifs. Jerome Powell may not really have time to fight that, and he may have to go the other way.
Or he might be too soon, exactly.
A delicate dance for the Fed chair. Of course, we'll be hearing from him in the next hour or so. But coming up on this program, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
All right, it's time now for Social Climbers, the companies making the most waves on social media this morning. And first up, Microsoft and Apple are dropping plans to take board roles at OpenAI. Now, this surprise decision underscores the growing regulatory scrutiny of big tech's influence over artificial intelligence. Big U.S. tech companies like NVIDIA, Alphabet, and Amazon have poured tens of billions of dollars into AI businesses. Next up, we have LegalZoom not passing the bar. The online law services company cutting its full-year revenue guidance below estimates and also announcing a sudden CEO change. Now, that news spurred at least 3 analyst downgrades, and you can see that in the stock down almost 31%. And finally, the discount chain Big Lots saying today it will close up to 40 stores this year and may declare bankruptcy. The company blames inflation and decreases in consumer spending. And you've also seen other brick and mortar chains such as Rite Aid and Red Lobster also announcing closures this year. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. So interesting to see more bankruptcies, more potential bankruptcies here. Of course, Red Lobster shrimping themselves to death. That was a big story a couple months ago, and we'll see.
Is that really what happened? Did they offer like never-ending shrimp, and that drove them to bankruptcy?
They did lose money on it, but probably not enough that would explain completely the bankruptcy.
Say about good intentions, right? Not all of them always work out so well. You know, actually, U.S. bankruptcies, according to S&P Global, reaching the highest monthly level since the early pandemic.
That is a cool function, by the way. BCY Go on the terminal allows you to break down bankruptcies into industry groups.
But you can also see where a lot of the pain is. Consumer discretionary, almost a fourth here of this year's bankruptcies. Healthcare, real estate also starting to stack up. Technology starting to rise as well. Remember, that is where a lot of those unprofitable companies are, and the capital markets has started to close to them. So a lot of ripple effects, and it really speaks to that dispersion investors are talking about.
If I could quibble, I would say that maybe the chart shouldn't be green. That makes it look like it's doing super well.
It should definitely be red.
It's good for the bankers and the lawyers. You know how expensive a bankruptcy is?
That's true. That's true. Someone does end up benefiting from that.
You can go into detail here on this function and see Mallinckrodt, Odyssey, Enviva, Yellow Corp. I remember that one. Joanne. All of these with 2, 3, 4, 5 billion in liabilities.
Bad for consumer options, by the way, at the end of the day.
All right, very interesting stuff on bankruptcies. It hasn't stopped us from hitting new records. Of course, it's really this rally been powered by 7, 10. Some have even said, Wilson says 50 stocks, right? His Nifty 50. And we continue to see futures rise into the open. Just got less than 4 minutes left, and we're up on the S&P 0.25%. We could have a 37th new record today. This is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
30 seconds until the start of trading after another record high for the S&P yesterday. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures pointing higher again today ahead of Powell's testimony. On the New York Stock Exchange, ringing the bell, we have Spectrum 360. That's a nonprofit that helps education for people with autism and related disorders. The New York Stock Exchange has always been a big supporter of autism. And Talon Energy starting to trade on the NASDAQ. Let's get over to Katie Greifeld right now. She's got a check on the major averages.
Yeah, you take a look at how the big indexes are trading as the bell rings. It's another update for the S&P 500, up about 0.3%. This would be number 37 for record highs so far this year. Take a look at the NASDAQ 100, up about 0.4%. We put the Dow Jones just for you, Matt Miller, and it's doing absolutely nothing. I'm going to go ahead and call that
39,000.
I'm not that excited. Let's talk about single stocks here because Air Products and Chemicals, it's gaining. This after Honeywell agreed to buy its LNG process technology and equipment business. It's a $1.8 billion all-cash transaction. Not seeing a lot of movements in the stocks as you might have expected, but still, Sonali, still really interesting to see a deal in this market.
Absolutely. M&A driving markets as well as leadership changes. Keeping an eye now on 3M. The company announced that its CFO is stepping down at the end of the month. You may remember here, Katie, that at 3M, they also had a CEO change earlier this year. 3M now up actually about 1% on the day. People seeing it as a sign now that perhaps a new CEO could put one of his own in place.
All right, NVIDIA also climbing higher today alongside other chip makers and AI-related stocks after TSMC. Let's get a closer look at Bloomberg's Abigail Doolittle. Abby, what do you got?
Yeah, well, Taiwan Semiconductor put up a great quarter, 40% sales growth, and as a result, you can see those ADRs up about 2%. But to your point, NVIDIA up nearly as much, and this has a lot to do with the fact that Taiwan Semiconductor is the sole provider of NVIDIA's most advanced chips, Apple's too, as a matter of fact. And when I use the SPLC, or the supply chain function in the Bloomberg terminal, TSMC is about 10% of their revenue or so comes from Taiwan, from NVIDIA, 25% from Apple, but that's why some of that strength is here. But we all know about the NVIDIA rally, but let's put it into perspective because one question everybody has, can it last? And you can see over the last year, up 215%, the SOX up 59%, and then the S&P 500, not shabby, 25%, but that equal weighted index up 8%. So again, can this last? One thing I would like to point out, Katie, is while their revenue growth is really robust, if we take a look at what's expected ahead in the last quarter, the fiscal quarter ending in January, up 126%. This current year that ends in January of 25, almost 100%. But then take a look at this, really a slowdown as investors start to focus on that. Unless they continue to boost, well, the shares may come back to earth.
And that, of course, would be bad news for the broader market, given it feels like the entire stock market rests on NVIDIA's shoulders. Abigail Doolittle, thank you so much. Joining us now is David Lefkowitz. He is UBS Global Wealth Head of U.S. Equities. And let's talk about your year-end price target, 5,500. The S&P 500, it's just below 5,600. Your upside target is 5,700. We're not too far away. Tell us about the path there between now and the end of the year.
Sure. Yeah, Katie. I mean, yeah, obviously the market has had a very good year so far, and we're just barely over halfway done. But look, I would say the broader picture is that the environment remains pretty supportive, right? We've got pretty good growth, pretty durable growth. We're seeing a re-acceleration in profit growth. I think as we go into the second quarter earnings season, we're probably going to see the fastest profit growth in more than 2 years, and a broadening out of that profit growth. At the same time, we've got inflation coming down, and it looks pretty likely that the Fed is going to start cutting interest rates. We think we'll get 2 interest rate cuts this year. And then you guys were just talking about all the AI developments, and clearly that's been a major positive driver for the market. So it's a positive backdrop. I would say it is tricky, though, because so many of the market gains, so much of the market gains have been driven by such a small number of stocks in the marketplace. That makes it tricky, but in general, we think it's a positive environment.
You know, we're going to talk with Jessica Menton from Bloomberg News in a moment about earnings season, and you mentioned the broadening out. Gina Martin-Adams from Bloomberg Intelligence wrote a note about that broadening out. We're going to see the first expansion for the S&P 493 in 7 quarters. But for the Mag 7, David, it looks like the incredible sort of explosive growth they've had. Earnings, I think, for the Mag 7 were up almost 60% in Q4 of last year, is going to continue to slow down. Does that concern you?
Yeah, I'm not too concerned about that, Matt. I think what investors are going to care about is, are those estimates do they get beat or missed? And we think the trends in terms of AI especially are still quite robust. I mean, we just saw the Taiwan Semi news. Companies are scrambling in order to put together the applications, make sure they have the investments in place to get their organizations ready for trying to adopt artificial intelligence. And we think those trends remain in place. So yes, revenue growth, earnings growth is slowing down for the Mag 7. It's still at a very robust pace. And it probably will remain faster than the 493 through the end of this year. As we get into next year, that's more difficult to assess at this point. But I think the key point is that will those numbers be beaten or will they be missed? We think there's still very good support for the Mag 7.
Well, another thing about this, too, even if you believe that the high flyers here have room to run, what about the rest of the AI universe? Do you believe that it's better to keep your chips on the table with the safest, biggest names that everyone has been flocking to? Momentum has been a big part of this market. Or do you start to look for some of the undervalued ones, the unloved ones so far, David?
Yeah, look, I think in terms of, technology adoption curves, I do think history suggests you do want to stick with the leaders. That the market, I think, has been very efficient about identifying which companies have the special sauce, which companies have the advantages that will prove beneficial as we adopt these new technologies. Now, obviously, that can change over time. And we're very attuned to that. And we still have a lot of questions around who will be the winners in terms of the applications that are ultimately developed. And frankly, will they come in time? That's in time to justify some of these valuations. These are all important questions. But right now, what's happening is that we're building out the infrastructure, and it's clear who has the leadership roles there. And we would say stick with those. Yeah, there certainly are, some ancillary companies that also stand to benefit, but the core of the portfolio within the AI complex should really be the leaders in the marketplace that have those moats around their businesses.
And it's a good point, too, that maybe when it comes to some of the users of AI, the applications, it's too early to pick winners there. Let's talk about something other than big tech. I know it's very hard in this market, but I'm looking through your notes. I see you also are positive when it comes to the industrial sector. What's the bull case there for some of the names in that group?
Yeah, so obviously we're building diversified portfolios. So tech is an element of it, but industrials, we think, is also kind of interesting here, especially because it's lagged quite a bit. It's a very heterogeneous sector, but there are a couple of segments that we think are interesting. First of all, if you look at transports, these are primarily the railroads, the parcel guys. We've been in a freight recession for some time now. We think we're nearing the end of that. A lot of the companies are executing on self-help measures, reducing costs, things like that. And we think that will start to bear some fruit. You look at the aerospace cycle. It's been hard for airlines to get new airplanes. So we're running the existing fleet harder. That means the aftermarket in aerospace is likely going to remain pretty robust. You've got the infrastructure leverage companies in there as well. There are maybe some risks around if there's a new administration. There are some companies leveraged to the Inflation Reduction Act and the green subsidies and things like that. But we think there's enough diversification. And I would say the last point here is that the ISM Manufacturing Index has been depressed for quite a long time now. Inventories are pretty clean. And we think it could be just a matter of time before we start to see a more persistent improvement in the ISM manufacturing, just the global manufacturing cycle. So you know, I think there's a number of positives in the industrial sector, but it is a pretty diverse and diversified sector.
You know, another part of this I want to talk about too is the financials. I want to shift right over there because, of course, we have the banks starting to report this weekend, but also a ton of divergence in how investors are viewing the opportunity in financials, particularly if you have interest rate cut priced in September. David, who wins in that scenario?
Yeah, so, you know, I think there are some cross currents in financials. You know, first of all, I think we also have to acknowledge that if there is a Trump victory or Republican victory in November, you know, financials probably are one of the better sectors or one of the best positioned sectors, because we'll probably get some deregulation. You'll probably get a little bit less focus on antitrust enforcement, which has been pretty stringent under the Biden administration. That'd be good for merger and acquisition activity, which a lot of the capital markets levered companies would benefit from. So, you know, that is a potential positive. And you're right, Sonali, as we get into Fed rate cuts, you know, cost of funding could start to improve. And so, you know, we're not making distinctions within the financial sector, but I would say from my perspective, there is potentially sort of an asymmetric opportunity here. If Biden and the Democrats stay in office, there's probably not much downside. But if Trump does enter office, you probably get upside from some of those items I was talking about.
David, I want to show a seasonality chart on the Bloomberg terminal. I'm sure you've used this function, but if I look at the S&P 500 and type SEAG GO, I can track how well the index has done over the 12 months of the year. I've looked at back 20 years. July is the best month. And I bring this up because Sonali asked if you keep your chips on the table, right? Is this a good time, considering that August is a bad month, September is a bad month historically? Is this a good time to take some profits? I mean, after the 17% rally on the S&P, can we expect a little bit of a correction here?
You know, I was just running some numbers yesterday. We haven't had a 2% down day since February of 2023. So yeah, it's been a remarkably slow and steady grind higher, and a pretty rapid ascent for some companies. But look, I would say, Matt, it still is a pretty favorable environment for all the reasons that we talked about, with the earnings, with the inflation improving, with the Fed now, you know, moving into a more dovish stance, which seems pretty likely. So I do think you want to stay invested. And you know, for our clients, we're building long-term portfolios, right? So we're not going to be too concerned about whether there could be, you know, a small sell-off, which is certainly possible, especially as we get into election uncertainty and things like that. But I would focus on the bigger picture here, that the environment is still quite favorable, you know, even though the market has been quite strong this year.
Got it. David, great getting you on our inaugural week. Really appreciate you joining us on Open Interest. David Lefkowitz there of UBS Global Wealth. Coming up, earnings season kicks off and growth may expand beyond the Magnificent Seven for the first time in 7 quarters. We'll discuss the companies to watch next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Goldman Sachs raising its target on Tesla to $248 after the EV maker reported better than expected second quarter deliveries. The analyst also cites reduced inventories levels and new IRA credit eligibility on some U.S. models. Next up, we have Needham upgrading Carvana to a buy with a street high price target of $160. The firm says that the online used car retailer has a profitable growth outlook. Now, the stock has climbed nearly 140% year to date, up another 7% or so today. And finally, we have Bank of America cutting its recommendation on Visa. The analyst giving Visa a neutral rating, saying that there's limited upside to its valuation. The firm also downgrading MasterCard, definitely something to keep an eye on as those big banks kick off earnings season this Friday.
Yeah, that is interesting. I mean, especially as we see that consumers are putting more debt on plastic than ever before, right? I don't know the exact number, but it's something like more than $17 trillion in credit card debt for U.S. consumers.
And you had the New York Fed consumer survey really just come out this week. Everyone is pointing just that out. And you have, for example, Bank of America now pointing out both Visa and MasterCard. Remember, these are two stocks last year, Matt, that were up more than 20%. Visa was up 25% last year. This is a question of whether they can really squeeze out more top-line growth when the consumer is already so maxed. And
Their hunch, by the way, I mean, that's the intraday, right? But if you look year to date,
Visa's not doing anything.
No, zero year to date. So really interesting stuff. All right, speaking of earnings, we're going to get a fresh read on the consumer tomorrow. I should say, speaking of the consumer, we're going to get fresh earnings tomorrow when Delta and Pepsi report. Analysts now focused on the S&P 500 stocks that aren't in the Magnificent Seven. Specifically, analysts at Bloomberg Intelligence, right? Gina Martin Adams wrote a great piece about it today. You can see it typing BIGO. We've got Jess Menton here on set. She's our senior equities reporter for Bloomberg News. And the thing that caught my eye about GMA's report is she says the 493 are going to start growing their earnings for the first time in 7 quarters. I didn't realize there'd been a contraction that's lasted so long.
That's right, because we had a 3-quarter contraction that ended in the 3rd quarter of last year, but during
For
that
the
time, overall for the index, that's
yeah.
correct. And then since then, big tech, not surprisingly, has been carrying that. If you look at this last quarter, still about 50% growth year over year, but the narrowing's happening because if you think of the base effects for big tech compared to, say, there was a bear market, the earnings outlook wasn't as strong in 2022, then a little over a year ago, NVIDIA obviously had that gangbuster revenue forecast, so that if you're comparing now to then, it's just not as extreme. But the point is when you're looking at more of these, say, consumer-oriented type stocks, things broadening out, because those were the ones that were really impacted with their margin growth. That was a problem, and that's really important to look at because especially consumer packaged good companies, and we have PepsiCo that's going to report tomorrow as well. If you think food and beverage companies, that's a real tell on the economy, inflation, and
am I slamming Ozempic? If I'm hitting myself up with a little bit of Bonjour or whatever it's called, then.
But so price to mix and volume, the whole reason that's important, I was able to interview Tom Barkin from the Richmond Fed a couple months ago, and they're watching that metric, and Jen Bartashis over at Bloomberg Intelligence, the reason it's important is because if, like, you and I, if we're going to a grocery store or paying money, that people are spending down. And so you're seeing that in earnings reports, say the last ones we saw a couple months ago from, say, Walmart, which had strong growth, and especially in its grocery segment. But if you move over and you looked at Target, a competitor, which is now in the staples sector in the S&P 500 because of its growing grocery business, it was struggling. And so people were spending more and trading down for something like Walmart.
Yeah, so we'll see if we can kick up the volume. It's been a lot of price so far. We only have 30 seconds left with you, but this revival that we're expecting in the other 493 stocks in the index, is that enough? Is that actually going to breathe life into this broadening out trade that we've been waiting for?
Well, if you look at the NASDAQ 100 equal weight, that's actually trading at all-time highs right now, and the S&P 500 equal weight hit at record back in March, but it's only about 4% off of that all-time high. So I know people keep talking about breadth and the issues with concentration, but we've been talking about that over a year now, especially after not even just this first half, but last year's first half too. So if you're looking at the equal weight, whether it's sort of with the big tech or even just broadly with the S&P 500, you're starting to see those stocks catch up.
Jess, we thank you so much for keeping an eye on these markets. Looking forward to having you back on the show. But next, we're going to talk about the trial of the decade, really. Jurors decide Bill Hwang's fate. That and more in our Wall Street Beat next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on the stock market right now. As it stands, the S&P 500 up about 0.3%, just 23 minutes into the U.S. trading day. The NASDAQ 100 leading the way, up 0.4%. And my favorite, we're taking a look at the Russell 2000, the small caps. To go from the big to the small, the Russell 2000 currently up about 0.4%, Shonali.
And it's time now, Katie, for the Wall Street Beat. We're going to talk about the most talked about stories in finance. First up being Bill Hwang's fate, now in the jury's hands. Remember, he's facing fraud, market manipulation, and racketeering conspiracy charges. And it's one of the most prominent white-collar prosecutions in recent years, and a very difficult one for the jury to distinguish between artificially manipulating prices and trading of stocks that he liked.
I want to just talk about the judge for about 30 seconds. The judge is 90 years old. We're talking about U.S. District Judge Alvin Hellerstein, sometimes losing his patience. He told the government at one point that, "I think you're wasting our time." And then he also told the defense that it was boring the jury to tears. This is a 7-week trial. It's obviously very complex. And this is a jury that's mostly with people from a non-financial background. So really...
he also asked, what's a meme?
Yeah.
Right? And didn't he stop the trial for a moment to show pictures of his new grandson?
He did.
Yeah.
He did, and I would say for those financial minds, this was not a boring trial at all.
It was the most exciting trial I followed in so long. The T-Live on the Bloomberg was insane.
Keep watching that T-Live, by the way. We're going to talk about another story next. Of course, that is private equity firm Clear Lake, best known for owning the Chelsea Football Club, at least $10 billion in distressed debt, prompting investors and creditors to question purchases it made at the height of the buyout boom. And of course, this story, guys, very well read on the terminal. A good reminder that private equity is not always private. Public investors own their debt.
Right. This isn't, by the way, when I read that, I thought, what, they're buying distressed debt? No. The debt that they own has become distressed.
Correct.
Right? And nonetheless, investors are still clamoring to invest in their new fund.
The reason this story is interesting, Katie, is because you have a company here that is facing a lot of troubles, a lot of the private equity industry is facing.
Yeah, and it's interesting, like, what do you do? Clear Lake, for example, uses continuation vehicles a lot compared to the rest of the industry.
Which, by the way, is selling one of your companies that you can't exit any other way to a new fund that you've raised, which seems to me to be a little bit sketchy.
It's a bit controversial, I would say.
Yeah.
It's very controversial, and, you know, it's also indicative of how closed this IPO market is. Yes, we've seen IPOs nowhere near as exciting as what a lot of people would have wanted out of this market.
That's a story I think we're going to continue to talk about on Wall Street Beat. Let's get to the trading diary right now. These are the stories you need to be watching this week. Today, obviously, Fed Chair Powell delivers his semi-annual testimony on Capitol Hill for the second day. He's going to talk to Congress today after the Senate yesterday. We get wholesale inventories as well at the top of the hour. Tomorrow, we get the all-important CPI, so a really good look at inflation. On Friday, we get big banks reporting. JP Morgan, Wells Fargo, and Citi really kick off earnings season in earnest, even though tomorrow we get Pepsi and Delta. In the next hour, we're going to talk to former Fed Governor Randy Kroszner ahead of day 2 of Powell's testimony. Is he satisfied that inflation is coming down?
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us, Alex Steele and Paul Sweeney, here in the Bloomberg Interactive Broker Studio. Coming up today, we're going to focus most of the program on testimony from Fed Chairman Jay Powell today in front of the House Banking Committee. That'll probably start around 10:15, 10:20 a.m. Wall Street time, so we'll bring that to you when it starts. Before then, we'll get us the lay of the land on the markets, and we're also going to talk to Mandeep Singh. He's Bloomberg's technology analyst. I want to get a sense, Alex and I were talking about Microsoft, Apple, pretty big news today, dropping OpenAI board plans as scrutiny grows. So these big tech companies are stepping back a little bit from the concern that they're getting too big in this AI thing. So we'll break that all down with Mandeep Singh. And then, of course, we'll bring you Fed Chairman Powell. Right now, let's kick things off with Mr. John Tucker. John, what do you have for us?
All right, Alex and Paul, this report being brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Stocks rising for a seventh straight day, so the S&P 500 headed toward its longest winning streak since November of last year. Traders are hoping to get more clues on what the Federal Reserve's outlook is as Jerome Powell wraps up a couple of days of congressional hearings. We are going to have his comments live as he also, in particular, takes questions from members of the House. Swaps traders pricing in about 2/4 point rate cuts in 2024 with a 70% chance the first comes at the September Fed meeting. Some of the individual shares on the move, most active, NVIDIA, Tesla leading gains in the mega caps. Advanced Micro Devices agreeing to buy Silo AI for $665 million in cash into it. Nora's going to take a deeper dive into this, but they're cutting 1,800 employees. And 3M's CFO stepping down to take the same role at another company. As a result of that, you have shares of 3M right now. They're actually up 0.2%. Treasury 10-year yields, little change. They are at 4.29, we'll call it. That's ahead of a $39 billion auction of the bonds. Yes, auctions can be interesting. S&P 500.
I don't believe that he means that.
I meant that. I'm so sincere.
I don't feel the sincerity.
17 points higher, the S&P 500. Another record close, at least we're on track in the early going. 55.94 in the index, up 0.3%. The Dow up 15 points, and the NASDAQ 190 points higher. That is up 0.4%. Of course, I'm sincere. Check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. Happy Wednesday, everybody. Happy second day of Jay Powell.
Yep.
I got to say, nothing is happening. I don't know what we're waiting for. Is it CPI? It feels like we're set up for an 0.8 of 1% swing, but...
I took his testimony yesterday, just his focus on the job market and how that's softening. I kind of was like some of the others out there that said, boy, that kind of makes me feel like he's more akin to be dovish if the data supports it, then maybe not. That was just my takeaway. We'll see if we get anything different today.
Yeah.
But that's kind of, markets are up a little bit.
But I buy that. Joe Weisenthal wrote in a piece today, which I, really highlighted that point, saying that when Powell said the labor is not a source of inflationary pressures now.
Okay.
Like that's the area that the Fed can control that like moves away from a wage price spiral. And does that kind of change the game?
Can I just ask on the political front to avoid the appearance of any conflicts or leaning one political direction or the other? Do they avoid September because it's too close to the election and maybe go earlier?
Ooh, like July?
Yeah, July. Well, that's their meeting. I don't think they have an August one.
I don't think they have an August one either. I don't know. I mean,
that would surprise the market, and I'm not sure in a good way.
Well, because also I think their meeting is 2 days before the jobs report. So I don't, that feels a little riskier. But, hey, I welcome all ideas. I'm inclusive in that. So, thank you for sharing that thought, John Tucker. All right, let's get some individual movers here. Norma Linda is joining us. You're looking at Intuit. What's going on here?
Yes, so as John was just mentioning, we are watching Intuit this morning after it said that it was cutting 1,800 employees. Now, this is about 10% of its global workforce that will be affected by this decision. But what the CEO did say is that the move is not meant to cut costs and that the company expects to rehire the same number of employees, primarily in engineering, product, and sales divisions. Now, we are seeing a bit of a split when we look at the analyst perspective on this readout. BI is saying that the job cuts could lead to sales challenges and that they believe that the consensus for 12% sales growth in fiscal 2025 looks challenging. On the other side, you have Evercore saying that this helps illustrate Intuit's willingness to make tough near-term decisions. And while laying off employees could be a tough decision, that these changes come from a position of strength.
I forgot how big this company was. I mean, for me at least, it flies underneath the tech radar. $175 billion market cap, so pretty substantial there. Stock's about flat year to date, up about 36% on a trailing 12-month basis, but a pretty big move there, 10% of the workforce. You don't see that in Silicon Valley.
Well,
often at all.
I feel like we are seeing it with software. Like, was it UiPath? Was that the company yesterday?
There was a bunch. Yeah, they're even
the
hearing it a
application
bunch
software
more
is struggling
recently.
because we're spending all that money on AI, and the software stuff is getting hit. Is that the read?
I mean, I think that there's a lot that people are really digging into when we do hear these numbers. But I do think what's really interesting to point out is that they do expect to rehire the same number of employees that they are letting go here.
Weird.
That's very interesting. What else you got?
Well, I'm also watching AMD. Of course, as we're looking at the tech names this morning, a lot of these mega caps, of course, we do know AMD to be a big competitor against NVIDIA. As John mentioned, it is agreed to buy Silo AI for $665 million in cash. And so we do know that this will kind of help it as it's really hoping to boost its potential, especially against NVIDIA as a company and it being a relative newcomer to the AI development field. But Silo AI specifically specializes in creating AI models and systems that are tailored to the specific needs of individual companies. And this acquisition actually comes on top of $125 million of investments that AMD has made over the past 12 months. And as I'm looking at the stock year to date, it's up about 20%.
I'm looking at the ANR function for analyst recommendations. 51 buys, 11 holds, and 1 sell. So
who's the sell?
It is Morningstar. So I'm going to say this, and nothing against my good friends at Morningstar. That doesn't matter. That doesn't count, really. It's not a sell-side brokerage firm. That's got a sales force and blah, blah, traders and all that kind of stuff.
Right.
But
it's
again,
a little different.
63 analysts following one stock. How's that economical?
Right, and actually it's nearing an all-time high. I mean, its market cap right now is $286 billion, which is right close to an all-time high despite this modest relative gain.
Okay.
And out of the tech space, you got Target. What's going on here?
Looking at a consumer name. I shop here, but Target has been rated neutral at Piper Sandler. It says that it has a strong omni-channel model and strong merchandising capabilities, but it says that it does not see a catalyst to push sales and margin above estimates in the near term. So it's been assuming, as I mentioned, coverage of this retailer here. And it does note that a year of declining sales in relation to boycotts has increased concerns over share loss.
All right, Norma Linda, thank you so much. We appreciate that. As always, Norma Linda, she covers the equities for Bloomberg News on a day when we've got a little bit, the Dow's off about 10 points, but the S&P's up about 0.3%, 18 points, and the NASDAQ is up, you guessed it, about 111.6%, so another strong day for technology. So there's a story out there, and the headline doesn't help me because I really don't know what's going on here. Microsoft and Apple drop OpenAI board plans as scrutiny grows. I thought we wanted the big tech names to be supporting AI, and I don't know what's going on here.
Also, it was like a free VC, wasn't it? Like they're just watching.
Yeah, exactly. But they tell me it's important.
Okay.
And Dina Bass, who's a really good technology, she's been a great technology reporter for, I'm going to say 30 plus years. I was reading her stuff way before she came to Bloomberg. All right, so I'm going to self-admit I don't know what's going on here. So I said, please get Mandeep Singh, because I'm just guessing he knows what's going on. Mandeep Singh, he's a tech analyst at Bloomberg Intelligence. Microsoft and Apple dropped plans to take board roles at OpenAI in a surprise decision that underscores growing regulatory scrutiny of big tech's influence over artificial intelligence. What's going on here?
Well, so, I mean, if you roll back to last year when we had the OpenAI drama, you know, the board firing Sam Altman, and then OpenAI adding 4 new members. And I think everyone so far has been just sort of interested in how OpenAI has evolved since then, in the sense that they have, even though they have added independent board members, Microsoft, you know, and now Apple probably would have joined the board. It doesn't make sense. Like, when you have vested interests, in the case of Microsoft, they have a 49% stake in OpenAI. And they're the primary cloud provider for OpenAI. How can you do a good job of being an independent board member? And that's where, you know, the regulatory scrutiny comes into play, because the regulators obviously are concerned about how Microsoft bought Inflection AI. Even though it wasn't an acquisition, they got all the employees of Inflection AI. So, well, that's what it comes down to, the optics of it here.
Break down for me again what the relationship is now with OpenAI and Apple versus OpenAI and Microsoft.
So Microsoft has a 49% stake in OpenAI. They made a $10 billion investment. And so you could argue, if you're an investor in a company, you should get a board seat, as is Sequoia and some other private investors that OpenAI has. Apple, on the other hand, just partnered with OpenAI, which is going to be one of the providers of Gen AI model on their iOS and other devices. And so it's more of a customer-supplier relationship, if you want to call it that way, that Apple is using OpenAI as a supplier. Why were they getting a board seat? Well, you could argue they could be an independent board member, like Fidji Simo is one of the board members for OpenAI. She's the CEO of Instacart. Now, I think that's where the fact that these technologies are so intertwined in terms of AI being deployed on Apple devices, you could argue that the independence of the board comes into question. And given how important AI ethics and guardrails and all the things that regulators care about, that everyone cares about, frankly, I think the independence of the board was questionable, and these companies decided to proactively not, join the board, which I think is good for optics.
So Microsoft is under scrutiny in Europe and by U.S. regulators into, I guess, their alleged dominance of AI. What's the view on the street about that risk to Microsoft and, I don't know, I guess at some point maybe Apple, I don't know, but certainly Microsoft?
I mean, the best way to look at it is these companies require a lot of compute for training their models, whether it's OpenAI, Anthropic, any of the independent Gen AI model providers, they need a lot of compute. Now, in the case of Microsoft, the arrangement is really, full of their interest because OpenAI ends up using Microsoft Compute for training their models.
All right, what does that mean? What is compute?
So think of all the NVIDIA GPUs that OpenAI needs, but it's deployed on Microsoft Cloud. So if I need compute to train the models, I'm not setting up my data center. Anthropic, OpenAI, they're not setting up data centers. They're using Microsoft data centers to get access to that compute. And that's where they could have gone to Amazon or Google to get that compute. The reason they're going to Microsoft is because of the, the stake they have and the board seat. And so if you are OpenAI and Microsoft is sitting in that board, are you really going to pick any of the alternative cloud providers for training your models?
No.
Probably not.
Do you feel like OpenAI will ever go public or be bought by Microsoft? Like, how does that situation play out?
I mean, everyone knows there are antitrust concerns around big tech buying any of these companies, so the acquisition is definitely out of the window, and that's why the way Microsoft got all the employees of Inflection AI, it was a pseudo-acquisition.
Yeah,
you get all of the employees, you pay $600 million, and you're not calling it an acquisition. So in the case of OpenAI, obviously that's not going to happen, but Microsoft does have a 49% stake. Google bought DeepMind for $600 million. Now, they bought it, a few years back, but it just goes to show how, these companies position themselves for the future, and they end up buying a lot of the startups. So I don't see an acquisition on the cards, but OpenAI is unique in the sense it's a nonprofit. And then they are looking to build a business out of it. So their structure was sort of very weird to begin with. And now they had that board trouble where it was a 3% board that fired their CEO. Now they're expanding with independent board members. So I don't think they've got it right still, but at least, not having Microsoft and Apple on the board is good in terms of optics. And that's what I can conclude here.
On surveillance earlier today, we had a London-based hedge fund, which I'd never heard of, Ruffer. They got about $38 billion in assets under management. They have a bearish call on the market. They think it's overheated, everything's overheated, blah, blah, blah. And that includes AI. Now, they're saying they believe AI. Now, of course, they've been wrong by their own admission, and they've been trailing their peers because the markets have been going up. But the AI call was simply that, AI is transformative, blah, 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 blah. But we don't even know what the uses are. And we don't know all the money that's being invested in AI. Explain to me what the return on investment is on that. How do you answer that or deal with that?
I mean, we know some tangible use cases right now. One is from a developer co-pilot perspective, AI works. And this thing is getting deployed at every company. Developers are using Copilot. Same thing with customer service chatbots. This thing is productivity enhancing. And this is getting deployed. So I think it's hard to argue that there is no tangible use case. But look, the valuations have run up, and there will be a disconnect at some point where valuations are way ahead of reality. And that's where, as an investor, you got to pick your spots. I mean, a TSMC will continue to benefit, whether it's NVIDIA, whether it's Apple, or anyone else that needs the latest chips for AI, they will continue to benefit.
And I think I can kind of write the press release from NVIDIA or any company that's really been lifted by AI. It's kind of a customer fatigue. They've already bought all this stuff. They've already invested all this money. Our customers have pulled 3 to 4 years of CapEx forward and spent it over the last 24 months. And we're seeing, instead of going 48%, we're going to go with 30%. That's a bad day.
Yeah,
for tech and for the market. I think that's a bad
And it's not going to be uniform. So some sectors will see very tangible productivity benefit of AI. Some others will have a delayed benefit or maybe no benefit. And that's where the disconnect will start to show up. But right now we are in that mode where everyone believes AI is the next big thing and it will have productivity boost.
And then just one quick point on what Paul was talking about too, just that the monetization part, like you say the use cases are there, but then how you monetize it, like we don't know what that really looks like yet. Like everyone's gonna keep wanting NVIDIA chips, okay, I get that, but then what the use case is for that, okay, then you gotta monetize it, and at some point, that's gonna have to be proven.
I mean, look at cloud. So when cloud came to the scene, everyone said, okay, it's a secular trend, but the monetization came about over time. And there are certain cloud native apps that really did very well as a business. So that's where an AI native app, I think it's going to do exceedingly well. Whereas if you're changing a business and you're overlaying AI, you may or may not be successful, but we'll find out.
Good time to be a tech analyst.
He's the best.
Yeah, I know.
Like, you can ask the dumbest questions, and he's like right there for you.
Yeah,
which I appreciate.
I know. It's amazing. Mandeep, thank you so much for joining us. Mandeep Singh, senior tech industry analyst for Bloomberg Intelligence, coming into the New York office, unlike his management team. So we appreciate that. Thank you, Mandeep. Right now, let's get a reset here with Mr. John Tucker,
the viewers manager. Right now, the major averages, they are mixed. The S&P 500 on track, at least right now, for the 37th record. You have 8 of the 11 major industry groups in the S&P 500. They are higher. Right now, we're being led by information technology and materials. Financials, that's biggest drag. It comes ahead of the bank earnings that we're going to get Friday as we start the next reporting season. S&P 500, 15 points higher. That is up 0.3%, 55.92. The NASDAQ 100, 91 points higher. That's up 0.4%. The Dow Jones Industrial Average right now is 8 points lower at 39,284. And again, ahead of the second day of testimony from Fed Chair Jerome Powell. Treasuries, the yields just lower. 2-year, the more policy reactive, down about 2 basis points. That's at 4.60. The 10-year yield is 1 basis point lower right now. That is at 4.28. And we check the markets view all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
Thank you so much, John Tucker. We are looking at and seeing Fed Chair Jay Powell. He is speaking in the House Financial Services Committee in his opening statement. We will bring you the Q&A when that kicks off. Steve Matthews is Bloomberg Federal Reserve reporter. He joins us now. Hey, Steve, anything we're going to hear different today than yesterday?
I think the plan is not to hear anything different. I mean, Powell's plan yesterday was pretty clearly to try not to make news. I mean, he was asked repeatedly about, are we going to get a rate cut in September or July or whenever? And he said, I'm not going to give any guidance on rates. And I think he was trying to be very balanced. In most of the recent testimony, the semi-annual Humphrey Hawkins testimony, he has tried not to make a lot of news because, and this is a particular political situation. It's right before the election. He doesn't want to make a lot of news. So I think that you're going to see the same tone today.
Alex, one of the things I love about Bloomberg and Bloomberg News is we actually have a dedicated reporter for the Federal Reserve. How cool is that? Nobody else does that.
No, it's really cool.
Yeah,
it's
Steve.
The best.
You're the best. Steve, thanks so much. I want to ask about, you just mentioned the election. Help us understand how the Fed thinks about timing of any rate movement and the election. When is too close?
Are you stealing John Tucker's question?
I am.
He's totally stealing John Tucker's question. Sorry, go ahead, Steve.
There is a theory out there among Fed watchers that the Fed would prefer not to move in September. It's the last meeting before the election. If they move in September, there will be complaints, oh, you're doing it for political reasons. What Powell has said about this is they don't think about it at all. If September is the right time, they will move in September. And, it doesn't enter their discussions or as an influence at all. So, some people believe there is a little bit higher bar to move in September. But, if that's what the data says is the right time, that they would go ahead and move.
I'm going to bring in what Joe Weisenthal was talking about in his column today, saying that yesterday the headline was Powell says that labor is not a source of inflationary pressures now. And his point was like, well, that's kind of the game, right? Like, if the Fed no longer sees the risks of that wage price spiral and that inflation spiral from the labor market, which is what the Fed can control, if the Fed looks at it that way, that could set them up for a cut. What do you think about that?
That's certainly true. I agree with Joe. Joe's a smart guy. Over the last 3 years, Powell has basically said it's all about inflation. We have one-sided risks. We want to return to price stability. The labor market is fine. Now he's saying there are two-sided risks. There's risk on inflation. There's risk on the labor market. And that does set up a rate cut. I mean, because, you know, they don't want to see the labor market soften further.
Steve, to make a rate change, either up or down, does it have to be unanimous, or what does the Fed like to do typically?
It doesn't have to be unanimous. Powell has kept things unanimous for the last couple of years. But I think, you know, particularly in the political environment, he would much prefer that there be a unanimous vote. But there are a couple of hawks on the committee, so that may be tough to get. I mean, you probably will get a dissent.
What do you think we're going to get tomorrow with inflation? Like, what do you think the Fed, I mean, Jay Powell yesterday definitely talked about how it's still going to be inflation X services, that core number, right? What do you think we're going to learn?
I mean, all the estimates are that the CPI is going to come in relatively low. And the Fed, you have to remember, is focused on PCE inflation. CPI goes into it. PPI, which comes out a little bit later, will also go into that. And after PPI, sometimes CPI can be misleading. After PPI, you'll get some estimates of what their preferred measure of inflation is for the month. And but the estimates are things are coming down, housing prices are coming down, and they know rents have been coming down, and that's delayed in the official data.
Steve, you know, the Fed had a knock certainly that they were too late to raise rates here, and that they really missed the boat there. Does that influence kind of their thinking today, or they just kind of slough that off?
It does influence their thinking in the respect that, you know, they don't want to see a recurrence of inflation. And if they're going to err on one side or the other, right, they want to err on the side of not seeing a recurrence. They're afraid that if inflation were to spark up again, that would be really problematic for inflation expectations.
All right, Steve, thanks so much. We really appreciate it. Steve Matthews, Federal Reserve reporter for Bloomberg News. Let's go down to Washington, D.C. Fed Chairman Jay Powell in front of the House Banking Committee. Right now, we're going to hear from Patrick Mahenry, the chair of the panel, North Carolina.
FCC and the FDIC agree on the substance of whatever changes you're going to make. What happens then? Like, walk through the mechanics as you anticipated.
Okay. So we're very close to having exactly that agreement on the substance of the proposed changes pursuant to those talks. The next question then is how to proceed. And, you know, it is my view and the strong view of a number of board members that the appropriate thing to do is to take that new proposal and publish it along with the effects of the quantitative impact survey and put that out for comment again and receive comment on that, and then take some time to review those comments before finalizing the regulation. And that's a discussion we're having with the other two agencies now. We have not been able to reach agreement on a path to do that, but that's something that we think is the right way to do. That's what we've done in similar situations. There aren't that many similar situations, but when we see broad and material changes to an important regulation, we think let's go out again and give all the commenters another chance to comment.
Yeah, and that also avoids serious lawsuit risk and the risk that Congress step in and overturn this rulemaking using the Congressional Review Act. I think the other agencies here, if they're not agreeing with the Fed, they're running against the independence of the Federal Reserve here. This is not a trifling matter of policy. This is a matter of real substance for the independence of the Fed and rulemaking at the Federal Reserve, which I think we should be able to keep the independence of the Fed separate, especially in this political environment. But opening up to a new comment period, so that means you have to get consensus for the Board of Governors on the policy. You have to get the agreement of the scandal-plagued chair of the FDIC or the five-member board of the FDIC. You have to get agreement by the acting comptroller of the currency. These people should not have real standing with the Fed on a matter of serious policy, especially with a chair of the FDIC that is being ousted by his own party as soon as they can get a replacement confirmed. It's an absurd thing that the Fed has to go to an acting comptroller of the currency and a guy who's going to be out of a job very soon at the FDIC and get agreement. But thank you for listening. That was more of to convey this. So the quantitative impact analysis, is this going to include the interplay with the stress tests, GSIB surcharge, all the other capital charges here? Will that be a part of the quantitative impact analysis?
It'll be this proposal, which does include changes to the GSIB surcharge, but does not include the stress tests.
Okay. But the goal here with the quantitative impact is to actually measure the impact of these rules as enacted, right? Based upon what is existing regulatory structures. Okay.
That's right.
All right, so let's get into the question of balance sheet as quickly as we can. 2.5 years ago, you stated, quote, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. That's 2.5 years ago. Where are we in this question of what are ample reserves?
Well, so the balance sheet, the runoff in the portfolio is now, I think, $1.7 trillion so far. So we've made quite a lot of progress. We think we have a good ways to go. And as I mentioned, and as you just mentioned, we've now slowed the pace really with a view to getting as far as we can without creating frictions and disruption that might cause us to prematurely stop shrinking. Going a little bit slower might actually enable us to go further. We think we have quite a ways to go. It's very hard to be precise about it. It's really a question of supply and demand. And we'll find that level with a little bit of a buffer on top of it, and that's where we'll stop.
All right, thank you for your testimony. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much. Chairman Powell, are you familiar with Project 2025?
You are listening to Representative Maxine Waters from California, the ranking member of the House Financial Services Committee, speaking with Fed Chair Jay Powell.
Don't focus on these things at all. I mean,
you don't focus, but you know there's something known as Project 2025? The reason I'm asking you is because one proposal is to get rid of the Fed's dual mandate to promote only stable prices, but also maximum employment. This is your mandate. These are mandates, right? This is what you do. Is that right?
We do serve a dual mandate, that's right.
And so if there was anything that would get rid of the mandate, what would it do to our economy? What would it do to our country?
So the question of which mandate we serve is very much a question for Congress. My own view has been that the dual mandate has served us well. This is something Congress can change and change back to a single mandate.
What do you do to get maximum employment? What do you do?
Well, we have one tool on the economy, and that is we raise and lower interest rates. You'll find, though, that anyway, we certainly at the Fed do believe that the dual mandate has been a good thing. And it's enabled us to, it has not stopped us from controlling inflation when that was the thing that needed to be done.
And so while, of course, I understand you may not have seen, heard, or read Project 2025, are you familiar with an effort in the country to get rid of diversity and inclusion?
I see these things mentioned, but honestly, we're pretty focused on our task, which is maximum employment, price stability. We're strong supporters of diversity at the Fed, as you know.
Are you aware that I created a subcommittee on diversity and employment in this committee?
Yes, I remember that.
And do you think that getting rid of diversity and inclusion interferes with your ability to really realize the mandate of maximum employment?
I spent most of my career in the private sector, and what I observed was really successful institutions in the United States, companies, organizations generally, are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table, and people feel comfortable speaking. So that's the way we feel about it at the Fed, and that's what we've been doing and will continue to do.
And do you think it's important not only to have diversity and inclusion in the public sector, but in the private sector also?
Yes, and as I mentioned, if you look at very successful American companies, you will very often see that they're good at that. They're good at hiring, attracting, investing in, and keeping diverse talent. That's one of the things that our really good U.S. public companies do well.
Have you seen improvement during your tenure where diversity and inclusion has created opportunities for more jobs and have to reduce the unemployment rate?
Certainly seen, I think you see over the course of my long career, a big change in diversity and inclusion. And you see that in the private sector and the public sector, and I think that's generally progress. I do.
Under the work of this committee, and the subcommittee is chaired by Ms. Beatty, she was able to gather important data about what was going on in the private sector. And what she discovered was that many of the CEOs and others welcomed the opportunity to learn more and to do better and to get assistance. And we saw improvement with diversity and inclusion. Have you seen that?
There's no question. If you talk to CEOs, they get this. If you want to attract the best talent in our country now, you need to be committed to these things.
And so I would like to compliment you on the job that you have been doing. I'd like to compliment you on keeping us informed about inflation. Not only do I welcome you here today, I look forward to working with you for years to come. I yield back. Thank you.
Thank you.
The gentleman from Arkansas, the vice chair of the full committee, Mr. Hill, is now recognized for 5 minutes.
Thank the chair. Chair Powell, thanks so much and welcome back to the committee. I want to pick up where Senator Tim Scott and Chair McHenry left off and reiterate my strong support for your comment yesterday in the Senate about...
Are you listening to Fed Chairman Jay Powell speaking in front of the House Banking Committee? French Hill, Arkansas Vice Chairman, is now asking questions.
Undergoes broad and material changes from the proposal to final rule. The public must be given a meaningful opportunity to review and comment on those changes. You generally share that view, I think. Is that right?
Yes.
And I'm looking forward to seeing the results of the quantitative impact study and the separate comment period, as well as an interagency agreement you referenced yesterday. Because of Dodd-Frank's role and the vice chair for supervision, Vice Chairman Barr's role and the Fed's role, would it be fair to say the Fed is a first among equals on proposing a rule like this? In other words, does the Fed have a supremacy position on determining whether it should be fully reproposed or not, or do you view it strictly as a collaborative basis? Just curious in your view on that.
No, I would say it's strictly collaborative, and I would say that our discussions with the FDIC, which Vice Chair Barr has actually been conducting, and the OCC, they've been very productive so far. So I want to make sure to say that we've continued to work our way through this, and I believe we will get fairly soon to a resolution of the remaining process issue.
Good. Well, let me turn from that subject to the court's recent decision to overturn the so-called Chevron doctrine. Many of us believe this was the first step to reining in decades, literally, of an unprecedented, uncontrolled growth in the administrative state. And so I think all of us on at least this side of the aisle are certainly saying to the Federal Reserve and other federal agencies in our jurisdiction that we want to reassert Article I authority over the direction that independent agencies work. Would it be fair to ask you to certify that because of this change in Chevron that the Fed would commit to promulgating new rules only if they're at the direction of an explicit congressional authorization?
So I think, first of all, we're studying that and several other decisions that have just come down in the last week or two. So I haven't got anything definitive for you on that. I think you know us to be an organization. I know us to be an organization that is strongly committed to the rule of law. Supreme Court says what the law is. We'll always do what we believe the law is.
Well, I'll submit that question maybe in more detail in writing, and maybe you'll have a chance to reflect on that. Back in February, you were on 60 Minutes, and you said the U.S. budget deficit, the national debt are unsustainable. Do you still view that the U.S. is on an unsustainable fiscal path?
I do. I think I tried to be clear that the level of the U.S. debt is not itself unsustainable, but the path that we're on is unsustainable, and I think that is not controversial.
I think many of us certainly agree with that, and we know that when the deficit's at 3 times the economic growth rate and growing, it's of concern, and it's contributed to inflation. Just 3 years ago in Jackson Hole, Wyoming, you gave a speech where you were confident that inflation was transitory, which I think we've come to realize that's not the case. This hearing is sort of a can't-miss opportunity for the Fed to demonstrate some humility on the monetary policy decisions, which some on this side of the aisle particularly think have made inflation worse. Your August 2020 Jackson Hole speech, you said the flexible average inflation targeting framework regarding 2%, that you would let it run above 2%. Was the Fed blinded by the previous 20 years of global change that was deflationary and or you were not alert enough in 2020 to be more cautious about that change in policy?
So we were certainly mindful of a long period of time in which there have been very low interest rates, but also very low inflation, suggesting that the neutral interest rate must have fallen quite substantially. That was the standard view. The thing we didn't see coming was the pandemic. It's not like everything went off the rails. It's like we had this pandemic and it really changed the way the economy is working. We had a big crisis. We did a lot of things. So the concerns that led us to those concerns that we were in a world of very low interest rates all the time.
But now wouldn't you say we're in a very opposite situation where because of reshoring and tariffs and other policies that are quite inflationary?
I would say this. Those concerns are, right now we have the policy rate in the mid fives, right? And we see the policy is restrictive, but clearly interest rates, the neutral interest rate must have moved up, at least in the short term. So I think that's the question we'll be asking ourselves in our review, which begins at the end of this year.
We look forward to that.
How much of what we did in that time period is relevant to the new world where rates appear to be higher?
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you, Chairman, and welcome, Chair Powell. It's great seeing you. Last time I saw you, we had the gracious pleasure of you visiting with me.
You are listening to the House Financial Services Committee. Fed Chair Jay Powell is being questioned now by Representative Scott from Georgia.
Now, Chair Powell, this year the Fed tested 31 banks, up from 23 last year. Is that correct?
I believe that's right, yes.
And by estimating losses, revenues, expenses, and capital level under hypothetical stress scenarios, we did that, correct?
Yes.
And all 31 banks remained above their minimum common equity tier 1 capital requirements after observing losses of nearly $685 billion. Is that correct?
Yes, that is correct.
Yeah, I wanted to get those figures out and provide you with, you may have heard this, but I want to share with the nation because your Vice Chair Barr made this statement, and I wanted to put this in the record, his exact quote from this great achievement. He said, "Our goal of our stress test is to help ensure that we have enough capital to absorb losses in a highly stressful scenario. And this test shows that we do." I thought that was a great statement of your record. Now, let me ask you my question. It's simple. Will the 2024 Fed stress test results have an impact on how prudential regulators roll out a new and updated capital proposal?
So the two are really two different things. There's the Basel III capital proposal, and then there's the stress tests. So, and really the Basel III, as I mentioned, we've discussed, we're almost ready to put forward for further comment a revised proposal with material and broad changes to it. The stress tests are a different thing, and of course we realize we have to adapt those over time and be open to changes. And it has evolved significantly over time, but it's really a separate thing from the Basel III endgame.
Give us a little bit more information on the Basel III, because I worked with you with this. Our work goes all the way back to the Obama administration when we responded to that crisis with our banks. And you and I worked that up where we came up with the hardest hit program to help those who were suffering with, those states that were suffering with high unemployment and at the same time high home foreclosures. And we were successful. And we've established that program, and it's still going on and helping many of our states. But I want to also share what is happening around the world as a result of our activities. The European Union is now set to delay key parts of its bank capital rules by more than a year so that their lenders will not be at a disadvantage. Over in Canada, it's important to know that their banking regulators have also delayed for another year, imposing high capital rules on countries' banks at the risk of making them uncompetitive. And the Swiss National Bank is highly unlikely now to adopt a proposed 15% capital requirement for UPS and other Swiss banks. And the Bank of England has issued a near final proposal to increase UK bank capital by 3% and I think this is all a measure of your great work and that of your vice chair. And I just wanted to let you have a comment on that, please.
Sure. So we're committed to finalizing this proposal. Our banks are going to live with these rules for a long, long time. The main thing is to get it right, and that's what we're doing. What we do in the end will be consistent with the Basel agreement, and it will also be consistent with what other comparable large jurisdictions are doing.
You're doing a great job. Keep up the good work.
We'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you very much, Chairman Powell, and also thank you for continue to indicate that you will look at the entirety of the economy, the whole economy. I appreciate that. So one of the nation's largest banks recently warned in a memo, and it's also been voiced by smaller banks at the current pace of regulation.
Fed Chairman Jay Powell speaking in front of the House Financial Services Committee right now. Dan Muser, representative from Pennsylvania, is asking questions.
Associated with checking accounts and other increased costs for small businesses. This does come amid expiring tax provisions that are sunsetting as we speak, that are critical for small business, such as the R&D tax credit, interest deductibility, and bonus depreciation. This does raise the question, are you considering how these regulations and tax increases will directly work against your mandate to achieve 2% inflation? Moreover, with the proposed changes to Basel III, it is crucial to ensure that all stakeholders have a voice in this process, which you are stating will occur. And a Basel re-proposal and adequate comment period are certainly very welcome. So, Chairman Powell, yesterday in the Senate, you mentioned that the majority view of the board is to re-propose Basel III for comment period. Could you clarify if this means the proposal will be re-proposed from scratch, and any other specifics you can provide?
Sure. So we haven't reached agreement on this. As I mentioned, we're working through this with our colleagues at the FDIC and the OCC, and I can't tell you exactly what the form would be. The sense of it would be, though, that we're making material changes and that we would want the public to have a chance to look at those changes in the light of the way they play off against the quantitative impact survey, and should have a reasonable time to comment on those. In addition, we're focused on one big area, but there are institutions that have made comments all across the spectrum, and we're reading all of those carefully. And we're not going to republish all of those. Some of those we can just make changes and move forward on. So it's going to be a very labor-intensive, time-consuming process.
Okay.
Writing these things up takes a long time, and we're going to get it right.
Good, that's great. Obviously, Canada recently postponed, as did the EU and UK, for international competition standpoint. It seems to make sense, and so that's appreciated. Chairman, would you agree that excessive spending, increased taxes, limits on domestic energy production, in principle, are a cause for higher costs for business, contributes to inflation, and as well tightens the labor markets, kind of running contrary to your two mandates?
You're asking me a kind of a political question there. I don't want to criticize a platform of economic fiscal policies that are not really ours to decide.
It's more of an economic question, but I appreciate your answer, sir. So when you mentioned recalibrate policy yesterday in the Senate hearing, was part of your thinking taking a more holistic view of economic conditions?
Yes, very much so.
Okay.
Yeah.
Okay. Chairman, is there any data to support the so-called greedflation? This term greedflation somehow has caused inflation. Is there any data to support those comments?
So we look at it that this inflation has been caused by a combination of very strong demand and constrained supply. So it was really a high-speed collision between an economy that was reopening, and by the way, there was inflation all over the world at the same time. So these are some common factors. But at the same time, you had tremendous demand, for example, for automobiles. You had constrained supply because there weren't enough semiconductors, long story short. But, so that to us is what this inflation is all about. So we've observed, the sort of healing of the supply side at the same time, restrictive monetary policies weighing on demand, and we've seen inflation coming down.
Right, so there's no data that supports that gouging of consumers is part of the inflation.
It's been very hard to track a connection with, earnings and things.
Secretary Yellen mentioned that she didn't feel that there was grocery price shock and that sort of thing. Groceries and gasoline are the two driving problems for American families and certainly my constituents. Do you believe your policies are helping to alleviate in those two areas?
So a lot of things affect, let's take energy first. The energy prices are generally set at the global level. We do have some effect on that.
Sorry, Chairman, I've run out of time. Thank you. I yield back, Mr.
Sorry, we can continue.
Great, thanks.
The gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here. In some ways, I want to follow up or at least respond to the very civil, but I think reason of why we need an independent.
You're listening to House Financial Services Committee, Fed Chair Jay Powell now being questioned by Representative Emmanuel Cleaver, representative from Missouri.
The question you raised would, if I answered it, it would be along some kind of a political avenue, and you didn't want to drive on that avenue. So I'm also very much concerned about a lot of the discussion. I've been on this committee a while, and so it comes up quite often. When the Federal Reserve was birthed around the turn of the century, I think around 1913, 1918, somewhere like that. Prior to the establishment of the central bank, was our country experiencing a lot of recessions because of no security? People felt no security, particularly the business community, in making big investments because nobody was in control. Just kind of think that what went on just went on. Is that relevant?
Yes, I think the lack of a central bank between 1836 and the founding of the Fed was a period of lots and lots of depressions, and a lot of it had to do with the crop cycle and the banks not being able to handle the very large seasonal swings, and there was no central bank to provide liquidity. So that's really what gave rise to the founding of the Fed in the early part of the last century.
Do you think that it would be that it is dangerous to blend monetary policy and fiscal policy?
To blend them?
Yes.
So we try to keep them very separate, and we try not to express views on fiscal policy. That's for elected people who have undergone elections and won, and make those very difficult decisions. We have a really specific, narrow but important mandate that you've given us, and we try to stick to that. And so we take your policies as given. And then we conduct monetary policy with that. I don't want to draw you into any kind of a political response, but and I have not read all of this Project 2025 document. I read some of it online a couple of nights ago, but even whether it comes out of a 2025 or a 3089, whatever. One of the things that I'm concerned about, reading this from this document, that the document argues that the Federal Reserve is the inflation problem, and eliminating the Federal Reserve, imposing economic policy on the Fed that does not come from within the Fed. So I'm wondering here, would you agree with any of that I just stated, whether it came from me or Chairman McHenry or anybody else? So I'll just say, first of all, we're certainly fair game for any criticism people have. I think what we've learned and what we know is that having an independent central bank is really essential. If you want to have high and volatile inflation, then the quickest road to that would be to undermine the independence of the central bank, of the Fed in our case. So I frankly think that view is very widely held. I find up here on Capitol Hill in both political parties.
So eliminating the Federal Reserve is best for promoting economic stability.
Yes.
Thank you. I knew that the ranking member was going to come in and deal with the issue of housing. She always does, and we all appreciate the fact that she's obsessed with it, and I like that obsession. But I'm wondering, as we try to figure out how to deal with this issue. Oh my goodness, my time.
Was that a question?
I didn't finish it, but yes. If you knew where I was going, please.
Gentleman's time has expired. We'll now recognize the gentleman from New York, Mr. Garbarino.
Thank you, Chairman. Chair Powell, thank you very much for being here today. Based on some comments you made today and yesterday, it appears you've made quite a bit of progress on changes to the Basel III Endgame proposal, and you're very close to agreeing some of the substance of those
listening
changes.
to Fed Chairman Jay Powell speaking in front of the House Financial Services Committee right now. He's speaking with Andrew Garbarino, representative of New York.
I just want to confirm what you said to my colleague, Mr. Musi. There will be, you're not reproposing some things, it's just going to be a partial reproposal?
That's what we're looking at doing, is major things that we've been working on. And there will be additional changes that will be made that won't be reproposed. That's what we're working on, rather than a full, wide proposal.
So it's not a complete reproposal, just partial.
Yeah.
Can you get at least can you tell me which components you're?
It's not until it's all agreed and ready to go and vetted. I'm reluctant to try to get into too many specifics, just because when you're doing these things, nothing is agreed until everything's agreed.
No, I understand. I'm not asking for what specifically your changes.
Yeah.
Which, if you're willing to say which.
I hope to be able to come to you with a really clear answer on that soon. I mean, I think we're ready to go at the Fed.
So that's my next question. So it's been said several times that you and many of your members of the board are at odds with your counterparts at the FDIC and OCC over how to proceed with putting out a revised proposal for comment. So if the FDIC and the OCC are not yet on board with allowing for a new comment period, who is holding up this consensus? Is it Chair Bloomberg? Is it Director Chopra?
I don't want to say that we're at odds. I just want to say we're working through this issue together.
Someone's got to be holding it up.
Well, you know, it's a discussion that we're having, and I think it's been constructive, and I think we'll try to keep it that way.
Can you at least answer whether or not the 5-member FDIC board needs to sign off, or can you just go to the chair?
No, I think it's the board, and of course the comptroller is one person, but I mean, the FDIC can speak for themselves, but I do think their board would be the question.
Okay. One final question, on timeline question before I move on. You mentioned yesterday that a reasonable prediction would be that Basel would not be finalized until the first quarter of 2025. Under this timeline, would it be safe to say that implementation would then not occur until at least the beginning of 2026?
Again, I can't be that specific. And, you know, that's, someone asked me, does it sound like the first quarter of next year might be? And I said, it might be. I mean, there's a range of times it would take. The thing is, as I mentioned, U.S. banks are going to be living with these rules for many years. The point of it is to get it right, not to do it quickly. You know, we want to get it right, listen to the comments, make sound decisions, and move ahead in a way that is, you know, gives us a sustainable set of rules that we won't have to come back and fix all the mistakes in.
Thank you. I want to move on to another topic, long-term debt. You mentioned yesterday that you would most likely not move forward with other rules until people reach a place of understanding and acceptance of a revised Basel proposal. I hope that's the truth, as banks need to fully understand the implications of a Basel proposal before any action is taken on long-term debt. Finally, Chair Powell, I'd like to emphasize the need for the Fed to conduct a comprehensive, data-driven, and most importantly, transparent assessment of the current liquidity framework. So very quickly, will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity requirements?
I didn't catch the first part of that, the first part of your ask.
Will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity
on the liquidity thing? I'm not exactly sure what we're contemplating there. We certainly contemplate getting a full range of input from the public on that, because some of these are novel ideas, and we understand that.
All right, as the chairman said before, these impact studies are very important because they're to show what impact these rules will have. So I think that is very important that we have that, because we had a mucked up process with Basel 2.0, and I don't think we don't want to repeat that. And I have a little time left. I'm going to yield to my colleague from Pennsylvania, Mr. Music, because I know he had another question.
I thank my colleague. Chairman Powell, just back to what we were talking about, the price instability of groceries and gasoline, where we do have somewhat of an affordability crisis, has been termed. So would lowering rates in the near future be a pro-growth initiative, perhaps? Is that something that's being considered?
You've been listening to the House Financial Services Committee questioning Fed Chair Jay Powell. We are listening to Representative Dan Muser from Pennsylvania.
Categories, and in the end, increase in supply, so as we lower those prices.
So, honestly, when we think about our near-term rate moves, we're thinking about a couple things, and the first of which is we want to be more confident about inflation.
My apologies, Chairman, I went over.
Sorry.
Chairman, I yield back. I yield back to my colleague.
The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you again for this hearing, and the ranking member, thank you very much. Chairman Powell, thank you very much for being here. We appreciate it. In fact, I was looking at your history when they were saying who nominated you, when you got here, and all that. In fact, you had public service even prior to that time, right?
That's right.
So I thank you.
You are now listening to Representative Juan Vargas of California, speaking to Fed Chair Jay Powell at the House Financial Services Committee.
You're pretty boring here today, to be frank.
Sorry?
You're pretty boring here, to be frank.
Thank you. That's a high compliment.
Yes, it is, because sometimes when you're here, there's all sorts of cameras here, and they're watching your every step and all. And I think there's a reason for that, right? And that's because the economy's doing all right. Am I wrong about that?
You know, take a look at our economy. We're growing at around 2%, it feels like. Inflation is down to 2.6%. Unemployment's at 4.1%. These are good numbers.
Yeah, I mean, I hear the parade of horribles on the other side, how the sky's falling. But I don't see the media here to attest to that. In fact, it's just the opposite. Did you read some of the headlines of the new government in Britain? Some of the headlines? If not, let me read one. It says, "New British government inherits worst economic plight since World War II." And in fact, there's a number of headlines like that saying that England's in trouble. I imagine if you were running their central bank, I bet you there'd be a whole bunch of media here beating you up to find out, what the hell you're doing or what you aren't doing. And I think the reason for that, again, is I think the government here has done a pretty darn good job. One of the things you said you didn't see coming was the pandemic, right? I'm not putting words in your mouth.
Right.
In fact, I was here and I heard the parade of horribles that we were going to have a recession, maybe a depression. In fact, the country was going to fall apart. Did it?
No. We went through a period of high inflation as the other countries did. And, that's very challenging.
And in fact, isn't it the case that most of those countries had higher inflation than we did in Europe?
Over time, there were times when their inflation was higher. I think overall it was broadly comparable.
Yeah, in fact, I brought it up a number of times here because there was a whole bunch of those countries that had much higher inflation than we did.
Well, Europe was much harder hit with the energy issues coming out of the Ukraine war than we were.
Sure. I mean, there's a whole bunch of other issues to instability. They had political instability and a whole bunch of other things, obviously. But, I mean, it is interesting today that, the parade of horribles that we hear doesn't seem to manifest itself with the media or the attention that you normally get. And that's good. I mean, I think that's a great thing. Now, I do want to ask a couple questions. I do have concerns, Basel III on housing. I think I've made those concerns known to your office, and I won't rehash them. But I do have issues that I want to talk to you about with regard to climate. Obviously, you said you don't read too much of the news. You didn't hear about Project 25. I don't think that's what you meant to say, and I don't want to put words in your mouth. I think when the ranking member asked you if you had heard about it, I think you said no. I think you've probably heard about it, but you haven't read it.
I've seen nothing more than headlines on it. I mean, I've devoted zero.
Yeah, me too. I don't read
energy
that.
into.
Yeah, I don't read that wacky stuff myself either, but I certainly read the headlines. But the reason I ask about the headlines is that you obviously have seen what has happened in Texas. You've seen what has happened with the climate change. And in fact, you've testified, I think, before that you believe in climate change. Is that correct?
Sure.
Yeah. And so what are we doing? You've taken a number of steps, I think, that have been very positive to make sure that we look at the risks of climate change. Could you go over some of those? Because that does concern me. I think that's a change that we also didn't see. Well, I saw it coming. I've been saying it for a long time, but a lot of people didn't believe.
So, if you're looking at financial regulators, you're looking at people who have a very, very limited role in climate, and that is just to look at the institutions that we supervise and make sure that they understand and can manage the risks that they're running. That we are not climate policymakers.
Right. And I'm not asking.
It has to be elected people who do that.
Right, but you have to take a look at the risks. I mean, look at the risks that the insurance companies are taking, and the banks, of course, are financing these homes, and now you can't get insurance on them, so all of a sudden you can't rebuild. I mean, these are risks that the banks are looking at.
So we don't regulate insurance companies.
No, right, but you regulate the banks.
Banks, yeah.
And these banks have mortgages on those houses, do they not? Many of them.
Well, in many cases, they're not writing mortgages anymore. So that's the result we're getting, is that banks are saying, they see these risks.
Yeah.
They do.
My time's up, but thank you again. Appreciate you.
Thank you.
The gentlelady from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being with us.
Hi, listen to Fed Chairman Jay Powell speaking in front of the House Financial Services Committee. Right now he's speaking with Representative Young Kim from California.
And I commend you for your leadership and staying focused on the core missions of the Fed, which are price stability and maximum employment. So thanks again for your leadership. And you have stated that it is the Fed's strong view that you will have to reopen the Basel III Endgame proposal for comment again. And I really urge FDIC and OCC moving forward with reopening the comment period. Chairman Powell, would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified proposal?
Sorry, didn't follow your question.
Would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified proposal?
I mean, broad support empirically would mean, a good solid vote on the Fed board. and I've tried not to be specific about what that means, but it also means broad support among the broader community of commenters on all sides. That's what I meant by broad support.
Got it.
Yeah, that's what I meant by it.
Thank you. And as the Fed looks to enacting several changes to the proposal, I would also urge you not to overlook how the Basel Endgame proposal would disproportionately impact FBOs and regional banks and U.S. domestic jobs because of the way the outside operational risk is, weighted. So can we get your commitment to that?
So let me just say I'm not going to get into specifics. We're well aware of those concerns. We've obviously carefully digested all of the comments we've gotten from all different sectors, and those are concerns that we're well aware of.
Thank you. Let's switch gear to another matter. You have spoken for the need of transparency. Are there any conversations at the Fed to have more transparency and better engagement and consistency with stress tests?
So we have increased transparency in the stress tests over time, and I would say we do. If people want to write articles and make comments that are critical of the stress tests, we're going to read those and we're going to think about that. We're open to improving it. We know that the stress test has to evolve over time if it's to remain relevant, and I think transparency is one of those subjects where we're prepared to listen and think about ideas.
Definitely. I would like to see more stress test regime that is more transparent and adapted, identifying unforeseen risks. So we can achieve that by being more collaborative, I believe, yes. So I'm also interested to hear from you whether you and your fellow banking regulators have considered the cumulative impact of any new liquidity standards with the Basel III framework and the existing post-crisis liquidity requirements. So what industry engagement has the board staff held with respect to changes to the liquidity framework?
So we haven't actually made any proposals on that yet. Mm-hmm. We have had significant industry interaction on the proposals, and we will move, I think, at some time this year.
What about the board staff? Have they conducted any industry-wide data collection to study the necessity for and the impact of any changes to the existing liquidity framework?
I think we've done a lot of investigation on that front, but I think that this is the beginning of the process, not the end. We haven't published proposals yet. We're working on them, and it's a pretty early stage.
Thank you. Let me quickly talk about the inflation issue. We had a peak inflation rate of 9.1% in June 2022, and a lot has been talked about being a supply side issue and the demand shock from the opening economy. So can you elaborate how the expansion in the money supply and fiscal stimulus played a role in persistent inflation, and why is it so important to get to the 2% inflation rate goal right now?
So the inflation that arose here was a collision between very strong demand as the economy reopened. Remember that there had been fiscal transfers. We had rates very low. Those things were done because we thought we could be looking at a very, very bad economic time. As it turns out, the economy reopened and demand spiked very high. People had saved a lot of money because they couldn't spend. And so there was tremendous demand and there was constrained supply. And what you got was inflation. And you got that everywhere in the world. That's what happened. So what's happened to bring inflation down, we've made quite a lot of progress on inflation. To bring inflation down, the Fed has been working on, with restrictive policy, on cooling demand. That has been working. And the supply side has been healing. And the negative labor participation shock has essentially reversed, adjusted for. So it's kind of working out as we had expected.
Thank you very much, Chairman.
The gentlewoman from Georgia, Mrs. Williams, is now recognized for 5 minutes.
Thank you, Chairman McHenry, and thank you, Chair Powell, for joining us today.
You're listening to the House Financial Services Committee testimony with Fed Chair Jay Powell. Speaking now is Representative Nikema Williams from Georgia.
Is a critical part of the Fed's dual mandate. When everyone in our community doesn't have the opportunity to contribute to their fullest potential, the economy is not firing on all cylinders. Nowhere is this more apparent than in my home city of Atlanta, which has more Black-owned businesses than any other city in the country, but is still among our nation's leaders in the racial wealth gap. I applaud you and your staff at the Federal Reserve for the work that you're doing to make sure that the economy works as well for the hardworking people of Georgia's fighting 5th District as it does for those in the top 1%. This includes helping to make sure that financial services are affordable and accessible to everyone. As the Fed moves forward with the proposed changes to Regulation 2, I know that protecting access to affordable and accessible banking is at the top of your mind. That is why I was concerned when I started receiving outreach about the unintentional effects that Reg 2 proposed rule would have on marginalized communities, including my constituents in Atlanta. Specifically, I heard about the impact that the reduction in interchange fees proposed by this rule could have on bank-owned certified accounts in my district and across the country. The Bank-Owned Initiative is a partnership between financial institutions and trusted community-based organizations to offer low or no-cost bank accounts to unbanked and underbanked individuals. Access and affordability are at the heart of the changes that you're proposing, and I couldn't agree more with those goals. But we have to make sure that programs designed to serve unbanked and underbanked individuals in marginalized communities continue to flourish. In response to these concerns, my colleague across the aisle, Mr. Lukemeyer, and I sent a bipartisan comment letter in March to you highlighting those very concerns and urging that the final rule not negatively impact low and moderate income communities. Chair Powell, how does the Fed take into account how regulations impact constituents who don't have an attorney or an interest group to submit a comment on their behalf?
Well, let me say first, we have heard those concerns that you raised and others have raised about aspects of the proposed rule. And, we very much understand the concerns that are being raised. In terms of people where we don't have comment letters, we try to be thoughtful about the impact of our regulations, but principally we're looking for public comment on things.
Thank you. The FDIC's most recent data shows that the rate of unbanked households is at an all-time low. The Bank-Owned Initiative has certainly played an important role in this progress. Bank-owned certified accounts are available to more than 95% of low and moderate income households across all 50 states. Access to low or no-cost banking services is a door to financial inclusion and wealth generation for marginalized families. As written, Reg 2 could undo some of the enormous progress made in the past several years. Chair Powell, how can regulators work with members of this committee to ensure that future proposed rules do not hinder Americans' access to tools that enhance the Federal Reserve's financial inclusion efforts?
So we're very focused on things like bank-owned, as you pointed out, and on access to the financial system for marginalized communities. So we wouldn't want to do anything to weigh on that. We were happy to work with you in your office on those issues. But as I mentioned, we're hearing the comments and we're reading them, and we're taking those into account as we think about appropriate changes to the proposal.
So we will definitely follow up on that, because as we're writing these regulations, I want to make sure that we're thinking about the real world impact and what it means to consumers when they're accessing financial institutions. I look forward to working with you to further the Fed's financial inclusion efforts. Like earlier this week, I sent you another bipartisan letter related to the Federal Reserve's April proposal to extend the operating hours of FedWire Fund service to 22 hours per day, 7 days per week, and every day of the year. That was news that I was eager to hear. This may sound like a small technical change, but it can have a big impact on our constituents, especially for those living in marginalized communities who live paycheck to paycheck. Growing up in the booming metropolis of Smith Station, Alabama, probably never heard of it, Chair Powell. But there are limited options for loans and short-term loans. In an area where everyone needs a car to get to work and they have to work to eat, when money is short, any delay in accessing a paycheck or paying a bill can disrupt your entire household. Extending operating hours for FedWire Fund service and National Settlement Service will allow people continual access to their funds outside of what we've deemed normal operating hours. And I hear the gavel. I'm out of time, but we will be following up for more conversation. Thank you.
Thank you.
The gentleman from Nebraska, Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, after a year with very high inflation that battered American paychecks, inflation rates have moderated some.
And we'll listen to Fed
However,
Chairman Jay Powell speaking in front of the House Financial Services Committee right now, speaking with Representative Mike Flood of Nebraska.
The inflation index has remained above 2% for the last 3 years. The Federal Open Market Committee's statement on longer-run goals and monetary policy strategy issued at the beginning of the year stated, and I quote, "The committee seeks to achieve inflation that averages 2% over time and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time," end quote. Chairman Powell, does the commitment to achieve a 2% average over time apply in the other direction as well? Meaning that if inflation remains above 2% for a protracted period, would the committee instead aim for inflation moderately below 2% for some time in order to achieve an inflation average of 2%?
No, it doesn't.
Is it fair to say that you would need to see the PCE index dip below 2% at least once in the coming months in order to contemplate a rate cut?
No, that's not fair to say. We've said that you don't want to wait until inflation gets all the way down to 2%. Because inflation has a certain momentum. You wouldn't wait that long. If you waited that long, you probably waited too long because inflation will be moving downward and will go well below 2%, which we don't want.
What combination factors would you need to see in order to support a rate cut this month or in September?
So once again, I'll say I'm not sending any signals on any particular date of any meeting whatsoever on policy. I said that yesterday and I'm saying it again today, but I will answer your question. So what we said is that we want to be more confident. We want to have greater confidence, and that means more good inflation readings. That inflation is moving sustainably down to 2%. Greater confidence that that is the case. But remember, we have a dual mandate too. We're not just an inflation targeting central bank. We also have an employment mandate. So I could also see us cutting, and we've said this, I've said this, if we saw unexpected weakening in the labor market. And we do now see, I'll speak for myself, I now see the risks to the two mandates as much closer to being in balance. I think for a long time we've had to focus heavily on the inflation mandate, but I think now we're getting to the place where the labor market is getting pretty much in balance to where it needs to be, and so we're looking at both sides.
I know that the media and others have continued to talk about the prospect of political interference with the Federal Reserve. With an election coming up, I know you are very aware of the heightened scrutiny awaiting the Open Market Committee meetings in July and September. Can you use this opportunity to speak regarding the Federal Reserve's political independence going into this election?
Sure, I'd be glad to. So, our political independence is critical to our ability to do our jobs and to sustain the faith of people across the political spectrum. And it comes down to, we make our decisions based on economic data, the evolving outlook, the balance of risks, and we don't take into consideration any other factors, including political factors. We have a long history of doing that, and I think the public believes we will do that. Any decision that we make on rates, on any of our policy tools, it's going to be very well grounded in the data, and it will represent our best thinking about what is best for the American public in the near and medium term. And that's the promise that I will give and that all my colleagues will give. And that means that we're not looking at things like election cycles. We're not looking at any of those things. We're looking at the data. What does it tell us is the right thing to do? When we figure that out, when we think it's time to move, we go ahead and move, but not until then.
Appreciate that. Finally, I'd like to raise concerns with housing costs. While shelter is one component of the broader PCE calculation, housing often makes up one of the largest, if not the largest, expense for many consumers. Inflation for housing remains persistently high. One of the characteristics of this economy is that consumer sentiment is remarkably low. Do you think high housing costs could be contributing to the persistently low consumer sentiment?
I think high prices generally. I think nobody really can be super highly confident of their answer on this, but I do think it's the fact that while inflation has come down, prices are high, if you know what I mean, and people are paying more for things, more for housing, more for the essentials of life, food, energy, and that to me is how I would explain surveys. We say that the economy's growing, inflation's come down, unemployment's low, and all that's true, but prices are high.
Thank you, Chairman Powell, for your answer and your testimony, and I yield back.
Gentleman from New York, Mr. Torres, is recognized for 5 minutes.
Thank you. Chair Powell, the Fed has an inflation rate target of 2%. Are you waiting for both PCE inflation and CPI inflation to fall to 2%, or only one of those metrics?
So we look at
listen to Fed Chairman Jay Powell speaking in front of the House Financial Services Committee right now, speaking with Richie Torres, Democrat representative of New York.
Because we think it's the better measure of the costs and inflation that the public